We came into this year with such high valuations, such stretched expectations that there still is very little room to absorb any kind of bad news.
It's clear that we do have a lot of headwinds mounting.
I can go across the board. Every single consensus trade has been upended.
Risk assets are very vulnerable.
This risk of something deeper than a 10% drawdown, that is rising.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, following the biggest weekly loss of the year so far, equities struggling to bounce as President Trump forecasts a transition period.
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of it takes a little time. It takes a little time.
Echoing sentiment from his Treasury Secretary Scott Bessent, calling for a, quote, detox following a boom in government spending. Sobering thoughts for the bond market this morning, sending bond yields lower across the curve, 2-year, 10-year, 30-year, across the board.
And really starting to price in some sort of downturn, if not outright recession. A number of different Wall Street firms talking about the increasing chance of recession. There is some kind of tell in what Donald Trump said over the weekend to Fox News' Maria Bartiromo, which is he seems to be leaning into the idea of markets selling off, almost saying, you know what, you have to be prepared for more of this, which raises the question, and Kellyanne Shaw raised this, what is he preparing markets for to come on April 2nd?
We're going to have a detox. We're going to have a transition. And only last week we also heard from the president, I'm not even looking at stocks.
He says he's not looking at stocks. He's taking a very long-term view when it comes to the entire composition of what they're trying to get done. At the Economic Club as well last week, Scott Bessent talked about we're trying to deleverage the government sector and re-leverage the private sector. What the market is waiting for and hungry for, Jonathan, and Kevin Hassett said this to you on Friday, it's time to get that train rolling when it comes to tax cuts, or at least extension of TCJA and deregulation.
So a few data points to watch this week. Let's start with PPI and CPI. CPI coming on Wednesday, the same day, Lisa, that we get inflation data. We've also got another deadline for trade tariffs, and this time it's 25% on steel and aluminum.
And it raises the question at a time where over the weekend he started talking about the potential for tariffs to go even higher on Mexico and Canada. We still are getting the 25% tariffs across the board on non-USMCA compliant goods. And that, I think, is important. The steel and aluminum still there. It raises the question, what type of reset is he going for? Is he talking about manufacturing coming back to the U.S., or is he talking about just simply shocking some of the world leaders into acquiescence for negotiating?
And how much pain are they willing to tolerate? I think that's the number one question right now for market participants. Stuart Kaiser over at Citi. Markets remain in a spin cycle. Morgan Stanley's Mike Wilson warning of another 5% downside, maybe more, on the S&P 500, saying no pain, no gain. The scenario where the fiscal drag, Doge and immigration enforcement hit the market first, then deregulation and less crowding out of the private market benefit the market, together with the deficit spending maybe a little bit later.
Well, politically, this is the way you'd have to do it, in the sense that they want to get all the quote-unquote bad things done that will hurt the markets early on, ahead of the 2026 midterm elections. Well, I will say, though, is that a number of companies, if you just look at the list of what they're saying ahead of CPI this week and what they're saying about tariffs, they're talking about the fact that they're going to have to pass some of this on. And even Alcoa in January was saying, depending on where metal tariffs come into place, we're going to have to look at potentially how we are going to trade differently when it comes to global realignment.
Equities right now pulling back by about 1 full percentage point on the S&P 500. Coming up this hour, Steve Chiavarone of Federated, following the worst week for stocks since September. Kim Wallace of 22V Research, as Trump says the U.S. economy faces a transition. And Kamakshya Trivedi of Goldman Sachs, with the dollar near the lows of the year. We begin this hour with stocks falling as concerns grow over the health of the U.S. economy. Steve Chiavarone of Federated is still bullish, writing, while we acknowledge that the risk of a short-term economic soft patch has risen, we remain constructive on the economy and markets in 2025. Steve joins us now for more. Steve, good morning.
Good morning.
They're telling us what they want. A detox period, a transition. How do you buy this market with that in mind?
Yeah, look, I think Trump is always a negotiator, and he's negotiating with three parties right now. He's negotiating with the Fed that he wants to have cut, and an economic slowdown helps. And he's negotiating with conservatives in Congress where he's looking for a bigger tax cut, and a slowdown helps. And he's negotiating with the bond market. If we were talking 3 or 4 months ago about tax cuts and rate cuts, we'd have 10-year yields north of 5.5%. And so I think that's the detox period that we're talking about. And what's the opposite here of what we saw back in 2017? In 2017, he was coming into a softer economy. He hit it with tax cuts first and then used that strength to try to do tariffs and some other things. Here, he had an economy that was very hot. Any whiff of stimulus was going to be an inflation and a rate problem. And he's doing it the opposite way. As Annmarie said, you're taking all of the pain first. So as an investor, if you wanted to get defensive ahead of this, you had to do it 2 months ago. And none of us did. And so now you're in a situation where if you think that you've got the better things to come, and look, tariff uncertainty may peak on April 1st, and you're likely to get into a negotiating on a tax cut soon. I think you've got to invest through this and see the better second half of the year in front of you.
To your point, though, the investor also has a sequencing problem now. And yes, you're too late. But do you want to buy the recovery before you've had the downturn? Because the hard data is still okay.
Yeah, and I think that's the big question. When we talk about recession, you mentioned the word recession. I think we're going to have one. But I don't think it's a United States recession. I think it's a Washington, D.C. recession. I think that's primarily what's being orchestrated. And the question is, can Washington have a recession and the rest of the country doesn't? I think if those savings get passed along, either in terms of a Doge dividend or in terms of a bigger tax cut or lower interest rates, then you can have a Washington recession and the rest of the economy does well. I think the key now is how long does the uncertainty play? When we talk to companies, they're cautious, but they're not pulling guidance at this point.
Hold on a second. I would believe what you were saying, the idea of a Washington pullback. Yes.
Okay.
It would make sense because essentially they want to strip away some of the public spending and put it back to the private sector. Where do tariffs go in from this, given the fact that you hear companies really retrenching some of their plans, and that's one of the reasons we've seen such a absolute bloodbath in the bank stocks?
So that's the longer term piece, I think. And there's a lot of risk around what they're trying to do there. But I think what we're trying to get to is growing our way out of a debt problem. And the only way you can grow your way out of a debt problem is grow GDP faster than you grow your debt. So if they can get the deficit down to 3, the question is how do you get nominal GDP growth at 5? And part of this administration's belief is one of the ways you do that is you bring economic activity back in the United States and you try to boost productivity. You shrink a less productive government sector, you feed a more productive private sector, and you try to convince companies through tariffs to come back. If that works, that's wonderful. Obviously, there's a lot of risk in trying that. And what I think is the key overarching theme here, which has Wall Street a little bit nervous, is we've had a reactionary fiscal and monetary policy for 25 years right now. This is predetermined, premeditated structural change with longer-term time horizons. The market hasn't really contended with that since Volcker.
Okay. The other thing I'm struggling with, and it seems like you are bullish and you are getting in there and buying and saying that there are going to be many more opportunities going forward just because of this is a sequencing issue. Since this is a slow-moving freight train, barge, whatever you want to call it, how do you do this in 6 months and then get all the good in 6 months? How do you expedite the time frame? So
you don't from an actual policy and economic perspective. The question is does the market root out what you're doing and then get bullish around it? Right, these are changes that are going to take a while to play out, right? Even if you're right on tariffs, and even if that does bring companies back, that takes years, right? The question is does the market look out and say, okay, well, there's fiscal sanity, or there's a push for growth, or we've gotten that chunk of the uncertainty behind us. We know the rules of the game, whether or not we like them or not, and now we're focusing on tax cuts and deregulation in the second half of the year. So I think the market can see that. I don't think that plays all the way through the economy. And by the way, as constructive as we are, I agree with some of the folks that you quoted earlier. I think we will still see pressure for a couple of months here, and equity markets are likely to go lower before they go higher.
What kind of sell-off could we see, especially if you think peak uncertainty around tariffs is actually going to be in early April?
I mean, one of the issues, I was looking at this morning, is we haven't had a 10% correction in 5 years. It's the second longest stretch ever going back to the mid-90s. And so, we look at what we're going through and it's like we're catatonic. I mean, you generally have a 10% correction per year on average. So, look, could it be 10% down? Could it be a little bit more? You tell me how long the uncertainty plays. You tell me how quickly we shift this narrative to tax cuts and deregulation and all that other stuff. You understand
why people are so nervous, though, Steve? Yeah. Because I think this goes beyond just a normal 10% correction in some people's minds, and I'll stress why. Yeah. We've built up this massive dollar long now for the best part of a decade, and that goes beyond just the currency market. That goes into tech stocks and a whole lot more. And a wind down we've seen so far, particularly in equities, goes beyond the banks you mentioned. It goes to places like Netflix. What has Netflix got to do with the kind of things that we're talking about? And that's the worry that people have right now, that maybe this is bigger. Maybe this is the start of a big unwind, of a big long that's built up over the last decade. And the sentiment shift we're seeing goes beyond some of these growth concerns. It goes to a sentiment shift to Europe, to China, away from the US. That maybe it's bigger than what we're talking about.
I'd be careful about that. I think you've been in a scenario right now where you're in peak uncertainty, and what that's done is created a desire for safe haven assets, long duration fixed income, defensive U.S. equities, and in that environment, you've seen non-U.S. do well as the dollar has softened some. That's great, because the world's looking at a period of time right now where you have kind of debt spending internationally and some austerity or restructuring in the U.S. I don't know that that's the world that we're in come 4th of July. I think come 4th of July, you may see tax cuts that are larger. You may see a president that's pushing Congress to include pay-fors that maybe don't materialize. And then I think you're back into a scenario where it could be stronger dollar, stronger U.S. growth, and you get an unwind of that trade. So I'm not trusting of that. And then in terms of worry, I mean, I get that, but that's what our industry exists to do, is not to worry and be able to figure this out logically. That's why we charge a fee. And so I get it, but, you know, we've got to...
So earn your fee. If we could do that right now. Let's do that right now. We've had a 9% move on banks just last week, close to those levels, almost wiped out the post-election gains for the KBW Bank Index. We've had moves of Nvidia down like 10% last week and down 25% off the highs of this year. What do you want to buy? What do you want to step into?
Yeah, so what we've done so far is we've kind of we've stood pat. So we came into the year about 5% overweight equities. You've heard me, it's like kind of waiting for Godot, but we've talked about overweight cyclicals, overweight some of those small caps. I want to buy the things that are in pain right now. I'd like to see the market a little lower. In fact, I'd like to see a little bit more dislocation in the equity market to jump in. But as I look at that back half of the year, I think we've gotten 2 previews of what it can look like. We saw it last July. We saw it last November. It's the cyclical trade. It's those banks that are getting beaten up. It's some of the small cap names. It's the names that benefit from that Trump agenda. It's short duration fixed income. But I think, you know, back in July, it started, and then Harris entered the race. And then it started again in November, and then Powell gave that masterclass press conference in December. I think it tried...
Masterclass.
Well, I'm being facetious, if you can't tell. And now I think we're waiting for that as you get rid of this pain stuff and you get into the kind of candy, which I think comes later in the year. So I think it's those things that benefit in the back half.
Steve, it's good to see you.
Good to see you.
As always, level-headed once more. Steve Chiavarone there of Federated Hermes. Equity futures right now down about 1% on the S&P as we kick off a brand new trading week. Let's get you updated on news elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Donald Trump says the U.S. economy faces a period of transition, declining to rule out a U.S. slowdown. Trump has argued that he's aiming to reshape the American economy with the belief that it would drive future prosperity. In Canada, Mark Carney has won the race to become the next prime minister. The former Bank of Canada and Bank of England governor will take over from Justin Trudeau. In his acceptance speech, Carney said that retaliatory tariffs would stay on until, quote, the Americans show us respect. Canada has met Trump's tariffs with patriotic fury and widespread boycotts of American goods. Taiwan Semiconductor's revenue increased 39% in the first 2 months of the year, driven by resilient demand for its AI chips. The world's largest chip maker is often seen as a barometer for the sector, and its growth is a sign of healthy spend on AI computing. Their future, though, is uncertain due to Trump's tariffs. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, a period of transition.
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time.
Up next on the program, Kim Wallace of 22V Research joins us next, live from New York City this morning. Good morning. 3-week losing streak on the S&P 500. A week 4 could be lower as well. Early days were down by about 1 full percentage point on the S&P 500. In the bond market, yields down 5 or 6 basis points. The 10-year 4.2455. Under surveillance this morning, a period of transition.
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time.
So here's the latest this morning. President Trump avoiding predicting a recession this year as his focus on tariffs and federal job cuts rattles financial markets worldwide. Bloomberg's Tyler Kendall joins us now for more from the nation's capital. Tyler, this is a different approach this time around compared to Trump 1.0.
Right, John, and it appears that the White House's message is that there will be a short-term adjustment period in order to have long-term growth. For example, later on in that interview, President Trump went to compare U.S. and China, in his words, saying that China has a 100-year perspective while the U.S. likes to think in quarters. That then led him to double down on the fact that he says he is not watching the stock market, though did say that he has his eye on interest rates. But it really does track with the messaging we've heard from senior administration officials in recent weeks, which is to focus on the broader fiscal agenda here when there are inflationary concerns, consumer sentiment concerns, or workforce concerns. And it's important that when we are talking about that long-term agenda, the White House is really banking on some things actually happening. And perhaps most pertinent to our conversation today, that's twofold. It's one, using tariffs as a revenue raiser, which goes hand in hand with trying to get President Trump's tax agenda over the finish line, something, John, that we know is not going to be easy. And those conversations are already starting as we saw the House Republicans float their short-term spending plan to keep the government open till September. That's signaling to us that they know that it's going to take months to get that tax cut agenda off the ground, considering there's disagreements over the tax priorities themselves, the mandatory spending cuts, and then actually how to get that bill over the finish line when the House and the Senate appear not to agree over that one big, beautiful approach that we know President Trump would like to see.
Tyler, when it comes to tariffs on steel and aluminum, is the White House prepared to enact them this week?
Well, according to Commerce Secretary Howard Lutnick in an interview over the weekend, he said that Wednesday should be the day that we are looking out for. He did, though, make some news saying that those reciprocal tariffs on Canadian dairy and lumber that President Trump had floated could come as soon as last Friday will be on hold until April 2nd. But as of now, we are expecting this to be a big tariff week. Looking ahead to those reciprocal tariff plans that this administration says will be part of this larger macroeconomic fiscal agenda that they are trying to get through.
Hey, Tyler, appreciate the update. More from Tyler a little bit later this morning. Tyler Kendall out of Washington, D.C. Joining us now to extend the conversation, Kim Wallace of 22V Research. Kim, welcome back to the programme, sir. I think we have to take a giant step back. Think about what we've been told over the last week. There's going to be a transition period. There's going to be a detox. They're going to try and rebalance the U.S. economy. Kim, when you talk to clients, what do you tell them the ultimate objective is? Rebalance towards what exactly?
We haven't been told that part yet, John, so I don't have advice for clients on where the end game is. I do focus on the uncertainty that's been mentioned a lot over the last week, certainly the last weekend and this morning, in fact. That uncertainty hinges on two of the three macroeconomic policy tools, both fiscal and trade. It is difficult to imagine with this level of uncertainty, and I would argue that we are months away, if not quarters away, from peak uncertainty. Markets get to vote on a daily basis, hourly basis. Voters aren't that fortunate. They don't get asked that often. And so you're not sure how the uncertainty is going to play out. It's very difficult to map, in my view, whether this is going to be wildly optimistic or something else because you just don't have enough details and you haven't heard from the stakeholders involved.
Well, based off how Trump dealt with the 25% on Canada and Mexico, what we did learn is that he is willing to negotiate. Do you think everything when it comes to trade from this point on, barring China, is a negotiating tactic?
Annmarie, I finished the week thinking that strongly, and I'm still leaning in that direction because of recent history. However, if the administration is putting together the concept and eventually a policy plan for financial repression that deleverages Washington, releverages the private sector, you have a lot of steps to go through before you get to that end point. And so I'm not sure what the administration's game plan is at this point.
Tyler just ended her report there talking about how Howard Lutnick, the Commerce Secretary, said that steel and aluminum tariffs will go in place this week, but they weren't ready to put the tariffs on dairy and lumber. So when you think about steel and aluminum, do you think that the president is just going to pull them back the same way he's pulling back dairy and lumber as well?
You know, I hate to keep going back to last week, but it might have been instructive. As we got information on fiscal policy, Secretary Lutnick was also at the forefront of negotiating in public on tariffs, moving dates back by a month or more. And so I'm not sure we've hit rock bottom on the public negotiating part from the administration. And I'm certain that we haven't landed squarely on what the policy objectives are.
We just had Steve Chiavarone on from Federated Hermes, and he was saying sort of akin to eating your vegetables in the first half of the year and then getting candy in the second half when it comes to a policy prescription. Do we have a sense of what that candy is?
I don't, and I'm not sure anyone does. And on the vegetables, the first question you ask, I grew up with a family of 4 kids. How many vegetables are in the pot? Are there enough to go around? That's the redistributive function of Washington. That's the political feedback function of democracy. We're at the early stages of gauging what this clearly secular turn in policy objective means for Americans, businesses, and markets.
Kim, is there anyone who speaks to you who actually says there is a lot of logic to this, that the fiscal trajectory for the United States is completely unsustainable, that had the economy remained strong with ongoing inflationary pressure, the U.S. would get hit with an interest rate bill that would be off the charts and that would stymie any potential longer-term growth and would engineer, frankly, a very deep recession? In other words, people who say it actually might be good if the U.S. economy shifts downward for a bit.
I've not heard that. You know, I've read sections, or this theory appears in section of Stephen Moran's essay at the end of last year, that you slow consumption in the U.S., and that slowing consumption causes contraction. But if you are gaining revenues from tariffs, then that might make up the difference in the lost revenue. What I hear more often than not from risk takers is optimal tariff theory hasn't impressed anyone yet. And when you see the speed with which China, Canada, Mexico, other trading partners either avowed retaliation or set up retaliation, and we'll have some of that from China today, if you're counting on optimal tariff theory to make up for fiscal cuts, and that revenue is going to flow because no one's going to retaliate, if everyone retaliates, your equation's in question, at least.
Kim, appreciate the update. It's good to catch up with you, sir. Kim Wallace there of 22V Research on the latest efforts from the Trump administration. This just dropped from HSBC. Prior to the US elections, we assumed that a Trump victory would reinforce US exceptionalism. Today, we're upgrading Europe to overweight from underweight and downgrading the US to neutral. What we underestimated was how the US's wavering support for NATO and Ukraine would trigger a watershed moment for the Eurozone. So for HSBC, it's not just about what's happening stateside, it's about what's developing over in Europe that's taking money away from that story.
We have seen the sentiment shift in massive form, and it goes to the question that you asked Steve Chiavarone. How much do we see a structural shift with a lot of the money shifting away from the United States to the rest of the world, not necessarily because of just what's going on in the U.S., but also because of what's going on elsewhere?
There's tons going on here and lots to catch up on as well. Lots to look forward to too. We'll be catching up with Veronica Clark of Citi in just a moment to talk about the labour market data from last week and the labour market data still to come this week. JOLTS data is just around the corner later this week, and we get a read on inflation, CPI and PPI. CPI on Wednesday, PPI later in the week, and another trade deadline, this time 25% tariffs on steel and aluminum. From New York City this Monday morning, you're watching Bloomberg TV. The worst week of the year on the equity market last week. On the S&P 500 this morning, further losses. We take more weight off the benchmarks here stateside. We're down 1% on the S&P. On the Nasdaq 100, we're down by 1.2. Stuart Kaiser of Citi. Markets remain in a spin cycle. Morgan Stanley's Mike Wilson, no pain, no gain. As we mentioned on the program about 5 minutes ago, HSBC downgrading US stocks to neutral.
And talking about where they actually like to put their money, which is Europe. And this goes to the question not just of what the United States is doing, but the response from others. And it's the reason why that is the wild card, just in this whole equation, how much that fiscal stimulus elsewhere, as well as potential counter tariffs, could shake up some of the grand plan.
Let's turn to fixed income, 2-year, 10-year, 30-year. That fear of softer growth starting to pull down yields. 2-year, 10-year, 30-year. We're down by 6 basis points on 10s, 424, 36. Last week we took a little bit of a break. The first week in some 2 months where we actually had climbing yields. They are declining once again, and we've got some key data points through the week, CPI and PPI. No Federal Reserve speak, a Federal Reserve meeting about a week away, and the final word came from Chairman Powell. Chairman Powell is not in a rush to cut interest rates.
He said that he expects that 2% inflation will continue to be bumpy, but he's not in a hurry. He is looking for more clarity. It sort of takes away the chance that they're going to cut aggressively. That said, nobody believes him. Everyone expects him to change as the data changes, so people kind of discounted that.
Well, put it together. You've got a Fed chair that's saying, I'm not in a rush to cut interest rates. You've got a Treasury Secretary saying that we're going to have a detox period. It's hard to be bullish for a lot of people when they hear those kind of things.
Well, bullish on anything, right? Because on one hand, except bonds maybe, and that's actually what Morgan Stanley is coming out and saying, that this increases their bullishness on bonds in favor of equities simply because they want that 10-year yield to go down even if the Fed's not cutting rates. And I think that's what they're setting up, that eventually the Fed will have to cut rates, but there's going to be pain in the economy. The big fear for me is some of this pain gets away with it, gets away from the orchestrator. I mean, the idea of job cuts can build on itself. And that seems to be a little bit of the fly in the ointment.
This is hard to manage. I totally agree with you. If it is by design, it's hard to manage. I want to talk about Europe. Hard to be bullish the German debt market last week. We had a move of more than 40 basis points on a German 10-year maturity. And in the FX market, what do you look to foreign exchange for? This is what I look for. When you loosen up fiscal policy, you look to see if it's validated by a stronger or weaker currency. We've got a stronger currency on the euro side of things, validating that loosening of fiscal policy potentially out of Europe and specifically Germany. The euro just had its best week since 2009. And euro dollar right now is pushing 109.
And a lot of people are saying it can only climb from here. 110 is some of the goals, but some people talking about even 130 on the euro. It goes to this question of can they actually come through with the plans that they have promised in Germany? And we're going to find out. They've got a 2-week window to get some of these plans passed and get the coalition they need. If they succeed, I expect these gains to continue.
Euro stronger by a third of 1%. On our radar this morning, Commerce Secretary Howard Lutnick signaling he doesn't expect a reprieve on 25% steel and aluminum tariffs. The measures are set to take effect on Wednesday and include imports from Canada and Mexico.
Doesn't sound like there's going to be exceptions or a pause when it comes to aluminum and steel. Those tariffs will be going into place this week. But of course, we just heard from Kim, our guest, and what did he say? What he took away at the end of last week is that Trump is in negotiating mode. One thing is clear when you talk to administration officials. April 1st, April 2nd is going to be huge. That's the day they're going to come out with these reciprocal tariffs. The question I have is which tariffs actually hit on April 2nd and which have weeks, months leeway because they're going into filing report and potentially another negotiating period for the president and foreign countries.
I'm trying to understand how different companies actually operate in this environment. And there is a study from Automotive News showing that roughly 1/3 of U.S. auto parts suppliers said they would move production out of the United States if the 25% tariffs on Canada and Mexico were to remain on for 6 months or longer. This is completely counterintuitive, but at a certain point, it would make it too expensive to produce in the United States. It just raises questions about whether this will have the goals and achieve the goals that they're setting out to do.
These are the economic outcomes. They're complicated. And I think that's really captured by what's happened in the FX market. There's so many different variables to manage. Most people assumed, though, if you were more aggressive on tariffs, you'd get a stronger dollar. We've ended up with a weaker dollar. That complicates things.
It complicates things because of what's going on elsewhere, but also because of potential growth fears. You cannot just say this is the sucking sound into Europe. This is also people starting to question U.S. exceptionalism.
It's shaking up the politics elsewhere as well. Check out this story. Mark Carney winning the race to replace Justin Trudeau as Canada's next Prime Minister, clinching nearly 86% of the vote. The transfer of power expected to take place within days, with the possibility of a national election soon after. So who's in a world of pain right now? Pierre Poilievre. Poilievre, the leader of the Conservative Party, is sitting pretty comfortable 2 months ago with a 20-point lead over the Liberal Party. And then all of a sudden this trade war starts and completely turns this race on its head.
They now actually, when you look at the polling, Canadians prefer Mark Carney goes toe-to-toe with Donald Trump when it comes to trade. You almost see Trump have a win and then push it too far. And then there's this rebuke that comes in Canada, and they're saying, actually, all Canadians need to stick together, and we're going to go probably stay with the Liberal Party. Pretty incredible. Mark Carney yesterday coming out. Hot rhetoric, Jonathan. So Americans should make no mistake. In trade, as in hockey, Canada will win.
You could have had this Conservative alliance, which would have enabled the Trump administration to achieve some of their goals, particularly on energy and perhaps even on fentanyl, someone that wanted to work with them very closely on a number of key issues. And now all of a sudden you're faced with Trump trying to work with Carney, potentially.
And an incredibly angry population of Canadians that want to really stick it to the Americans. It just shows how things can change while you enact some of the policies that you set out to do.
We've still got to have an election. We'll see what happens in Canada later on this year. But ultimately, this is not where we expected to be only 2 months ago, north of this country. Let's turn to what's happening over in the Senate. House Republicans are unveiling a spending bill to help the government open through September 30th. President Donald Trump calling on lawmakers to pass the bill ahead of a shutdown deadline on Friday. This is the House, of course. Then we need to move to the Senate. What's going on with this effort?
So it looks like it's likely going to pass. Donald Trump is definitely going to be calling everyone if there's fear. He said last night at the end of this week, it could happen a funding lapse, but it probably won't. I agree with him. It could happen because you never know with Congress if it becomes silly season, but it probably won't. As soon as Tuesday, tomorrow, we can have a vote in the House, then it moves to the Senate. They have till Friday. Likely this is going to go through. You know why? It's politically unstable and not good for anyone to be blamed for a shutdown, Democrats or Republicans.
And I assume once we get past this, we move to tax cuts. Just how long and what is the timeline for that now?
We move to debt ceiling and then tax cuts. Tax cuts is going to be an end of the year, end of 2025, because there is a deadline for that. TCJA, some provisions of it expire. They have no choice if they want to extend that policy. Or, as Scott Besson has talked about it, you will see a tax hike, which they definitely don't want to do.
Are those tax cuts the candy? I mean, that's sort of what I want to ask. If eating your vegetables, and by the way, I like vegetables, so I don't know why that's always considered a negative thing, is the first half of the year is, some of the Doge cuts and some of the tariff wars. Is that what we're looking forward to, an extension of the trade, of the tax cuts?
Lots of people don't like their vegetables, Bramo.
Do you like vegetables?
Sure.
My kids like their vegetables.
OK. So we come up with something new for you?
Yeah.
All right, like what?
Eat like Twinkies the first half of the year. I'm not a big Twinkie person.
Can I move on? We should probably move on. Recession fears rising on the heels of increased tariffs and federal job cuts. Veronica Clark of Citi writes, the payrolls report was not far off expectations, but details of the report suggest a softening trend in labour demand. Veronica joins us now for more. Veronica, good morning. It's good to see you.
Good morning. Thanks for having me.
Let's talk about those details. Where do you see the weakness? What concerns you at the moment?
Yeah, on the surface, this looked like a jobs report that looks like the last 6 or 7 months. We had the unemployment rate staying in that range it's been in, 150,000 jobs. That's fine. But it was really the increase in the unemployment rate, so it's still in the range. But that occurred alongside a decline in participation, so people maybe leaving the labor force. Unemployment rate would have been even higher, something like 4.4% if that hadn't happened. And then even in the details of payrolls, hours worked that are coming down, it doesn't feel like there's a lot of demand for workers right now.
Which raises this question of how resilient this labor market is in the face potentially of a policy shock that a lot of people are talking about. What's your sense? I know you guys have been saying that the economy was weakening. How offsides are people in their expectations of the robustness of the U.S. labor market?
Yeah, we have been seeing this weakening for a while. Primarily, this has looked like a very low churn labor market. That's low hiring, low quits, low layoffs. But that low hiring dynamic, I do think it's restrictive rates that got us here. And that means the labor market's not very well positioned to absorb a shock, even if it's coming from the government. Obviously, we're tracking the numbers of those layoffs, and the direct impact of those might be minimal enough. A couple tenths on the unemployment rate could get bigger. But I would really worry about the spillover to private sector contractors and just hiring that is so low and might be going even lower in face of uncertainty. Why would you be hiring people right now? And that could be the bigger impact on the labor market.
It seems like there is a grand plan. And there's sort of the sense that you take your pain up front and then some of the positive, and you rejigger the U.S. economy. And it's moving on a 1 or 2 year cycle. President Trump saying he judges himself in quarters. Can you talk about the time frame of a labor market that is much slower moving?
Yeah. I mean, we've come a long way in terms of the labor market loosening already, of course. We had the increase in the unemployment rate last year. Had looked like maybe there was some stability. But I think, we're at that point where in past cycles, you see this much sharper increase in the unemployment rate. That's the layoff stage of this weakening labor market. So it's been slow moving for now. It's been maybe taking a bit longer to get to that last stage than usual. But this could be what pushes us there for sure.
What kind of impact is DOGE having on the labor market?
Yeah, I mean, we do track, the outright numbers of layoffs that we've seen so far. We'll start to see that, I think, in the March employment report. It wasn't as, showing up in this February data quite yet. But we're, something around 40 to 60K right now. The bigger numbers would come over the summer. We have these plans for mass layoffs that are supposed to happen over the summer. Maybe we're looking at something like 300,000, maybe more.
Do you think the private sector could absorb these jobs?
I don't think so. I think this is a private sector also that has been weakening for a while. Hiring rates very low. Of course, the private sector is going to feel some of this also. Government contractors, just general uncertainty. Those are going to be people who are not spending in the economy as much. There will be ripple effects.
Isn't that the ultimate goal of the administration, though? The ultimate goal is to rebalance the economy, and your response to that is, I don't think so. You don't think this is possible?
In a nice orderly rebalancing, I think no, because I think we had a weaker view of the economy, going into this year already, and I think we've seen that in the data. This is a really precarious labor market that maybe can't handle some of these changes.
Is it a rebalancing the Fed needs to support?
I think the Fed will be there to support the labor market. Obviously, we do have concerns of inflation, and tariffs are related to that. But if this is a true weakening economy, maybe you can't pass on those price increases as much. You can't demand a higher wage, and so you're not actually as worried about the persistent inflation from this.
What does the Fed have to see then in order to actually start cutting rates? Does that sort of avoid a recession, or does that mean that we have to see the whites of a recession's eyes before they start engaging?
I think they will probably be getting more concerned on the labor market on the growth side of things. And so if you do see some inflation data alone that look a bit more favorable, maybe Wednesday's numbers add to that confidence that inflation is slowing, then they can be cutting as soon as May. That's our base case.
Wednesday for CPI, the following week, Fed Chair Jay Powell, a news conference and Fed decision on March 19th. Two things to look for. Veronica, it's good to see you. As always, thank you. Veronica Clark there of Citi. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Donald Trump says that he's negotiating with 4 different possible buyers for TikTok's U.S. business, and that a deal for the app could come soon. Trump didn't specify who the contenders were. TikTok does face an April deadline to strike a deal for its U.S. operations or be banned from the U.S. under bipartisan law passed last year. Elon Musk is calling on the U.S. to quit NATO. Musk responded to a post on X that called for the U.S. to exit the bloc, saying, "We really should, and it doesn't make sense for America to pay for the defense of Europe." NBC earlier reported that Trump has discussed calibrating U.S. engagement with NATO, favoring countries that pay a higher percentage of their GDP on defense. Elsewhere for Musk, Tesla shares are falling more than 3% in the pre-market. The EV maker's shipments in China have been declining for 5 straight months. They fell 49% in February compared to a year ago. Tesla has been losing market share to companies like China's BYD. That's your Bloomberg Brief. John.
Hey, Danny, thank you. More from Danny later on this morning. Up next, is the U.S. losing its edge?
Currency, rates, relative U.S. equity performance to the rest of the world, all the consensus trades at the beginning of the year have been upended. This notion of the U.S. edge, and I worry that this edge is being eroded right now.
Up next on the program, we'll catch up with Kamakshya Trivedi of Goldman Sachs from New York City. This is Bloomberg. Leaving behind the biggest weekly loss since September, And adding to it, we're down by more than 1 full percentage point on the S&P 500. In the bond market, a rally here developing. Euro to lower by 5 basis points. The 10-year 424.55. The euro stronger, dollar weaker. Euro dollar approaching 109, 108.63. Under surveillance this morning, the US losing its edge.
Currency, weights, relative US equity performance to the rest of the world, all the consensus trades at the beginning of the year have been upended. The US is still, whether you want to call it the cleanest dirty shirt or whatever, but it's simply not as clean for outsiders as it was a few weeks ago. This notion of the US edge. And I worry that this edge is being eroded right now.
So here's the latest this morning. Investors looking for opportunities outside of the United States on growing economic fears. Kamakshya Trivedi of Goldman Sachs writes, our economists expect the US tariff rate to rise 3 times more this year than it did during Trade War 1.0. To a large degree, the dollar outlook depends on the balance between US policy changes and the foreign policy response. Kamakshya joins us now for more. Kamakshya, welcome to the program, sir. I want to pick up on this dollar trade story first of all and just figure this out. Last time around, tariffs up, dollar stronger. And we came into 2025 thinking about the same kind of playbook. We've turned it on its head. Tariffs up, dollar weaker. What's changed?
Good morning, John. Thanks for having me. So it's not just the difference between last time around. Think about the response to the imminent threat of tariffs on Canada and Mexico just at the end of January. At that time, we also saw dollar down, near-term rates up. What's changed? What's changed is that at that point and through much of the trade war 1.0, the markets were very focused on the inflationary impacts of tariffs. What has happened in the short span of a month is that as U.S. growth views have repriced lower, the focus has shifted dramatically to the downside growth risks for the U.S. economy. And that's mediating the tariff response. And so now, when there is threat of more tariffs, when that uncertainty rises again, the market is more nervous about what that is doing to U.S. growth and the downside there than it is to the worries about inflation. And I think that's what's causing the tariff response to be much more muted on the dollar.
Can we sit on that, the idea that slower growth in the U.S. is causing investors, traders to move away from the dollar? That's different than in the past, because it's not just the U.S. that's going to face a growth shock from some of these tariffs. It's other economies as well. Why is it that the U.S. is looking like maybe it'll suffer more or it'll have a more significant deterioration than it did just a month ago?
So I think some of it, is just the way the data has panned out. I mean, relative to a lot of expectations, including ours at the start of the year, the increase in tariff uncertainty and the broader environment of policy uncertainty appears to be weighing more on the U.S. economy than the trade uncertainty appears to be weighing on whether it's Chinese data or European data. If anything, those look to have bottomed a little bit. So just in the way the data evolution has played out, I think markets are seeing that concern reflected more on the U.S. side than in the rest of the world. But of course, I think what your question also refers to is there has been some stuff going on in the rest of the world as well. You've had a big shift, German fiscal policy turning on its head, China at the 2 sessions also talking about, a bigger fiscal deficit. That takes you to a big step towards achieving better global balance. And that's what I think is also weighing on the dollar.
I get the story, especially given the fact that you have the biggest potential fiscal spending package going back decades in Europe. But there's a question of whether the narrative has gone too far, especially we're talking before April 2nd when the real bazooka or the real tariff plan will ostensibly get released. Is there a risk, in your view, that people have gone too far with this narrative, that the U.S. dollar is basically peaked and that the euro is the new place to be?
I worry a little bit about that risk as well. We've made a very big shift in markets over a very short period of time. You were showing the euro dollar that's gone up from, close to parity towards nearly, 110 in the, matter of a couple of weeks. So, there are risks and, this big shift in fiscal spending, the shift in policy that we're talking about in Europe, there will be potholes, there will be hiccups. Nothing ever happens easily in the euro area or in Germany, especially when it comes to spending money. So I do worry that, tactically you could see some reversals. But I also think it's important to zoom out a bit and focus on the big picture. If you were thinking of a macro constellation that would lead to an erosion of the overvaluation of the dollar, it would look something like this. It would look like a modest slowing in the U.S., U.S. growth repricing coming down, more fiscal spending in Europe and China, and a more balanced profile of asset market returns like you've been getting in the relative equity performance as well. So in terms of the bigger picture, I don't think we have gone too far. Of course, you could have some tactical back and forth.
When it comes to President Donald Trump, at one point during the election campaign, he wanted a weaker dollar because of trade, manufacturing in the United States, and wanting to sell products outside. Do you think this is part of what they're trying to do when it comes to global realignment?
I think there are parts of it, certainly sort of the pressure on the rest of the world to boost domestic demand, to boost defense spending. That is all, part of, I think, that global realignment that the new administration has certainly talked about. I don't think, however, that there was a desire to engineer a weaker dollar by, having more weakness in the U.S. economy. That was certainly not part of the agenda and is not part of the agenda going forward. So I do think there are aspects of it that one can pin there. And again, I think that is the big picture to focus on. Does the rest of the world really step up to the plate to generate this more balanced global growth and global asset market picture? Or is this just a question of U.S. growth being a bit softer? Because if that's all that you get, it's going to be a much more risk-off picture.
I was looking at Kit Jukes' note this morning. He talks about the CFTC data that basically wiped out the entire euro short. And we have this huge repricing, and he's talking about, but we don't have the GDP forecast yet to back it up. So how do you think about the rest of the year if you have the FX market basically whipsawing just on headlines?
I do think there's going to be a lot of whipsawing on headlines for the rest of the year, so I think we all have to be prepared for that as FX investors. But you make a good point. I think that the move in the euro, the move in currencies generally, I think the move also in the relative equity performance and rates, I think has run ahead of the kind of GDP forecast changes just for 2025. But as always, I think the market is looking ahead. It's not just looking to what this means for 2025 growth, but what this could potentially mean for 26, for 27. That broader increase in demand, in the demand impulse coming out of the euro area, that's been very absent for the past few years. If that plays out, that's a pretty big shift. I would not underplay it.
Let's just finish on Europe, and I want to talk about Italy. The good news for Italy and the Italian debt market is spreads were pretty steady last week. The bad news is that because spreads were steady, it meant yields also rose in Italy by 42 basis points. Now, I wonder when that starts to become a problem, or whether you just see that as a factor of better nominal growth, a rebalancing in Europe, and a better story for the Italians. Is it good news or bad news?
The key, as always, is growth. I think in an environment where the cyclical growth views in Europe are being upgraded, if Europe, in Italy, Europe and Italy can both have that higher nominal growth profile, I think sovereign spreads will be okay. I think Italy will be fine. I think that if you get just the fiscal spending and yields going up, but you don't see that follow through in growth, you don't see the follow through in nominal quantities, I think that's when the sovereign side of things starts to get a little bit tricky. That's not what we expect, just given the nature of the news flow that we are getting so far.
And we're certainly not there yet. It's good to get your thoughts, as always, sir. Thoughtful stuff from Kamakshya, Trivedi there of Goldman Sachs on Europe. Not a problem for Italy yet. Will it become a problem further down the road?
I love this. Let's talk about Italy. How beautiful is it? Can we go there?
Italy's still beautiful.
Yes, okay.
I'm not sure how beautiful the bond market will be in several months' time.
It raises this question of, is there a self-limiting factor to the spending plans that are getting priced in as fact before they even happen at a time where the economy there still needs a lot of growth? So it does raise this sequencing issue for Europe at a time where the market's getting a bit ahead of some of these plans.
Defense spending is one thing. Infrastructure spending is quite another. And we need to see what's actually going to take place in Europe. Of course, the market's anticipating that and getting ahead of it. Euro-dollar very close to 109. In the second hour of Bloomberg Surveillance, we'll catch up with Kennon of Clear Harbor Asset Management, Henrietta Treyz of Veda Partners, former NEC Deputy Director Kellyanne Shaw, and Michael Zezas of Morgan Stanley. From New York, this is Bloomberg.
Those animal spirits that we were talking about just 2 months ago, I think that's been replaced by recession fears.
There's a very big difference between falling into a recession and collapsing growth versus decelerating growth.
The appetite among households, businesses, and the market for the inflation side of the picture is very different now.
The slowdown is taking place, and we will see more of it. It'll snowball as things go forward.
This notion of the U.S. edge, I worry that this edge is being eroded right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning, the second hour of Bloomberg Surveillance starts right now. A defensive setup in financial markets across assets to start this morning and a brand new trading week. Equity futures on the S&P near session lows and down by more than 1 percentage point. On the Nasdaq, we're lower by 1.2. You'll see a similar picture in the bond market. Yields down on a session on a 2-year, 10-year and 30-year. On a 10-year this morning, we're down 6 basis points to 424.17.
The big question here with this type of setup with bond markets seeming to worry more about some sort of economic downturn is the Trump put dead, or is it just in hibernation? Is there a point at which Donald Trump does come in and start to support some of the equity valuations? Or are we talking about the wrong game? Are we talking about a game that prioritizes something that is no longer on the horizon, and we're really looking at bond yields coming down and a reordering of global trade in a way that we haven't done for decades?
A bit of de-risking has started. Who's going to step in? Not the Federal Reserve, Chairman Powell. We're not in a hurry. Who's going to step in? Not the President of the United States. They are very well aligned right now, both the President and the Treasury Secretary, on rebalancing this economy.
They keep talking about this period of transition. Trump over the weekend said on Fox News, you can't really watch the stock market. That's not the barometer of what they're watching in terms of where they want to go. And then he went on to say, if you look at China, they have a much longer term outlook on what they're trying to do. We work by quarters. They're not focused on the stock market. Between Secretary Bessent and Donald Trump, they cannot make it any clearer.
They're not focused on the next 3 months. They're not looking at the stock market. This is a shift from where we were back in 2016, 17, 18, as we worked through the first term of the Trump administration. So we've got to rely on the economic data. CPI on Wednesday, PPI on Thursday. Can the inflation data open the door for the Federal Reserve to step in and reduce interest rates?
Well, some people might see that as potentially the case. The problem with all of this data right now is if you're taking a look at February, are you really getting a clear picture on the trajectory ahead? And do you understand the ramifications of current policies on the underlying
Biden
economy?
data.
It's Biden data, unless it's good, and then it's Trump data.
But definitely Trump data.
There just is this ultimate question: how do you calibrate an economy on backward-looking data that's moving very quickly at a time where a growing number of analysts on Wall Street are just throwing out their assumptions and saying, we just don't know?
I go back to what Mohamed El-Erian had said to us at one point when we were in that inflation cycle. Listen to what corporate executives are saying. Here's the list. Best Buy, the giant wild card, obviously is how the consumers are going to react to price increases. Why are you having price increases? Potentially because of tariffs. Kroger possibly shifting to geographies that will be less affected by the tariffs to keep prices low. Very interesting in terms of what these executives saying. Lori Calvasina was talking about the fact that tariffs continuously come up.
I think they've been very clear about what they want to do here. The question I would have is how much pain are they willing to accept in the meantime? And we've talked about what they're trying to achieve. Lots of government at the border. Immigration's going to come down. Tariffs are going to go up. Lots less government inside the border. Spending's going to drop. We're going to allow the private market to step in. That's the rebalancing that they're talking about here. And for a lot of the bulls out there, they're sitting here saying, look, the strategic anchor for us is that the policy mix is still positive, and in 12 months we'll be in a better place. The question you've got in the near term is, OK, how much pain are you willing to accept? And if you're an investor at the moment, are you willing to buy the recovery to the downturn that hasn't happened yet? Could it get a whole lot worse than this at a time when the hard data is actually still OK?
That's what you asked Steve Chiavarone. And he said, yeah, you kind of have to stay invested. It could go down before it goes up. But still, the good is coming on the back end of this year. The question I kept asking myself over the weekend, and this is something that the Fed and Mary Daly over at the Fed has talked about a lot. Job losses get entrenched, and the loss in buying power and earning power stays for a longer period of time. And there are scarring effects that come with rounds of layoffs that do start to escalate on themselves. I'm not talking about DOGE, but on a broader economic level. Does it get away from some of the overall grand plan?
It reminds me of Chairman Powell back in the summer of 22 when he talked about pain, which at the time I thought was easy for Chairman Powell to say because he's unelected. The midterms are going to be just around the corner. next year, the end of next year, and they're going to come up so quickly. How much pain are you willing to accept with the midterms coming up?
It's one of the fundamental problems where people have these plans that can only be executed over years, but they have to operate in quarters, just like President Trump was saying.
And that's why China, of course, has a 100-year plan, because they don't do elections. It's another story. Not a story we want to hear stateside, by the way.
Yeah, I was about to say.
On the S&P, just to clarify.
Really?
Just to clarify. We're down by 1.2% on the S&P. Coming up this hour, Aaron Kennon of Clear Harbor with markets whipsawed on tariff and growth concerns. Henrietta Treyz of Veda Partners with President Trump's steel and aluminum tariffs on deck. And we'll speak to the former NEC Deputy Director, Kellyanne Shaw, on why ambiguity is a feature and not a bug. We begin this hour with stocks low, with the S&P 500 extending losses following the worst week since September. Aaron Kennon of Clear Harbor writing the following: investors are attempting to determine whether tariff policy will prove more bark than bite. More bite creates higher costs, and more bark generates more noise. Aaron joins us now for more. Aaron, let's talk about the price of noise. What is the price of that noise?
Well, certainly we're seeing, markets shudder here in the United States, but rally abroad. We're seeing huge liquidity tectonic shifts happening, Jonathan, and that's a function of many factors. But one is the U.S. backing away from an 80-plus year historical sort of security agreement with Europe and our other allies, from Singapore to Japan and beyond. And I think Europe particularly has awoken to this reality just over the last couple of weeks. You've reported on this quite well, and you just have Germany out last week. I mean, this is a country that has embraced austerity. They have a very high savings rate, and yet they're going to spend 20% of their GDP over the next 10 years to defend their country, and the EU is going to spend up to €1 trillion or more to do the same. Whereas here in the United States, we have the tariff debate, we have DOGE, and we have that fiscal stimulus that began during COVID really waning now, not to mention that the president has cut off the remaining funding from a good portion of the CHIPS Act and the IRA, the Inflation Reduction Act. And that's only, going to reduce liquidity in the United States. And then, of course, you have valuations in the United States, which are expensive relative to the rest of the world. So lots to contend with right now.
Aaron, how much are you buying this idea that there is so much more to come with some of the gains in European markets at a time where we're pricing in that they will do all of these things, like you just said, even though there still are a lot of potential roadblocks?
Yeah, Lisa, I think the next 2 weeks in Germany are important because you have the parliamentary seats changing in late March. So if they can move before then, I think there's a much higher likelihood that some of this spending will, in fact, occur, that Parliament will pass funding in Germany and that the EU will rally. This is an existential threat to Europe. And so the notion that they're either going to spend or not spend, I think this is now being taken very seriously in Europe. Donald Trump was asked whether or not he would defend a NATO country last week in the Oval Office, and he balked at it. And he said, well, if they've paid their bill, what does that mean? Does that mean that if they move their defense spending in a country like Estonia from 2% to 4%, but they only make it up to 3.9% upon being, attacked by, let's say, Russia, that the United States wouldn't come to their defense? There are huge unknowns here. And I think that's the problem, too, with tariffs, Lisa, that there are unknowns here. It's not that the market can't react to a tariff if we understand what the details of the tariff are. It's that there's so much uncertainty on both timing, carve-outs, which countries are next. Is it China, and then is it maybe the next largest economy in the world, Germany, and then Japan? What's the order? What's the cadence? There are a lot of unknowns, and I think that's really rattling markets.
And one of those unknowns is whether the proposed spending in Germany can even happen. There's a headline that just crossed the Bloomberg that the Greens won't support the draft debt package in Parliament. Do you just assume these are teething problems, or do you think actually there is a chance that maybe these plans don't become reality?
Sure. There's certainly a chance. I just think that this is the first moment in my lifetime where this type of spending is occurring for a reason that's existential to, the sovereignty of these nations. And so there's a greater likelihood than not that finally we will see it. But for sure, I mean, we've seen this story before, Jonathan, in Europe, post 08-09, spending during COVID. It always comes out a little lighter than we anticipate, and we have to keep that in mind.
Aaron, last week we were talking about how a lot of Wall Street firms don't want to be the first to change their views on the year. But suddenly we're getting a lot of revisions to the view ahead in terms of downgrading U.S. growth, upgrading expectations for European assets. Can you give us a sense of what you've actually been doing in the past week or two? How much you've been shifting allocations on the heels of some of the fundamentally transformative news that we've been hearing?
Yeah, well, I was on in early February, and we mentioned the importance of really thinking long and hard about capital flows into Europe. And so on the margin, we've ensured that, to the extent that clients who need to have non-U.S. exposure or should have non-U.S. exposure, that, we're looking at our targets and making sure that we're at the right levels there. We're also thinking about non-correlated investments here in the alternative space, whether that's statistical arbitrage or just, traditional merger arbitrage. There are many sort of non-correlated alternatives, not just private equity, not just sort of like private credit, which is highly correlated to the overall market that we're looking at. And then just thinking about the fixed income market, where do you want to have duration when the U.S. economy is slowing down? And where do you want to have your credit exposure? So we're keeping our credit exposures more in the short end of the curve, and we're pushing our sort of treasury mortgage-backed security duration a little further out the curve. This was what we've been doing several weeks ago, and that's worked out reasonably well. As growth expectations in the United States have come down, you're able to capture a little more upside as those treasuries rally in the long end of the curve.
Aaron, appreciate your time, sir, as always. Thanks for breaking it down for us. Aaron Kennon there of Clear Harbor Asset Management. Just to return to that headline, two things to look at in financial markets, just to take the temperature of this story. One is the bond market after a 40 basis point plus move higher in 10-year yields in Germany just last week. And the other is the FX market after euro charged high through last week, the biggest week of euro strength going back to 2009. So first of all, to the German debt market, where yields are a little bit lower, down 4 basis points on a session, and the euro coming off session highs, but still stronger on the day as this headline crosses out of Germany, that the Greens won't support the draft debt package in Parliament.
If they don't get some more support behind this proposal, it's not going to pass. It needs a 2/3 majority for a constitutional amendment to eliminate the zero debt break. Just to give you a sense of what the time frame is, discussions and negotiations in Parliament will take place on March 13th. The planned vote is on March 18th. So how much is this a negotiating tactic, and how much is this basically the Green Party saying that this isn't going to happen?
So based on the market reaction, and I'll let the market do the speaking because I won't offer my opinion, I'd say the former and not the latter.
Exactly, that's my
But ultimately, Lisa, we'll see.
Which is the reason why I think it is fair to say Europe has often struggled to get something of this magnitude passed. The fact that the market is running away with the story, and we were talking about this with Kamakshya Trivedi, how much does that really put the euro dollar at risk of some sort of violence, as this is going to be a choppy procedure?
But one thing is for sure, the Greens hold the cards. This entire idea, this entire package will either fall or will pass whether the Greens sign up or not, which is why they have a tremendous amount of leverage. And to Lisa's point, they might be using that leverage right now.
You'd have to imagine there is an ask, and maybe a big ask. Right now, the euro just off session highs, euro dollar 108.47. Let's get you an update on news elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Starting in D.C., House Republicans unveiled a spending bill to keep federal agencies open through September 30th, setting up a potential confrontation with Democrats. President Trump called on GOP lawmakers to pass the bill, warning them to allow no dissent in their ranks. Congress must act by midnight Friday to avoid a partial government shutdown. Israel has halted its already limited supply of electricity to the Gaza Strip, a move the government said was in response to what it called the Hamas hostage crisis. The 6-week Gaza truce expired a week ago. The sides are divided on conditions for an open-ended suspension of hostilities. Morgan Stanley's Michael Wilson says that stocks are at risk of slumping another 5% on concerns about tariffs and lower fiscal spending. The strategist says that he expects the S&P 500 to fit a low of about 5,500 in the first half of the year before recovering to 6,500 by year-end 2025. His target implies a rally of 13% from current levels. And that's your brief, John.
Danny, thank you. More from Danny a little bit later this hour. Up next on the programme is a recession on the table.
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time.
Up next on the programme, Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. Stocks are softer here. We're down 1% on the S&P 500. In the bond market, yields are lower by 5 or 6 basis points. The 10-year 4.2455. Under surveillance this morning is a recession on the table.
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time.
So here's the latest this morning. President Donald Trump refusing to rule out a recession with more tariffs set to take effect on Wednesday. Bloomberg's Tyler Kendall joins us now from D.C. for more. Tyler, a debate that we're having around the table throughout this morning is that they seem to be very, very keen, determined, in fact, to rebalance the economy. The question we've got, and maybe you can help us answer it, how much pain are they willing to take?
Well, John, it does appear that there seems to be a higher threshold for pain here from this White House than previously believed. And you even had President Trump talk about this idea that he acknowledges that there's a disturbance, but there doesn't seem to be any indications that they're going to change their policy rollout. In that same interview, President Trump was asked whether or not businesses can expect more reliability when it comes to his tariff plans. And his answer was that he's at liberty to hike tariffs even higher. And he's not quite sure if there's really any predictability around that. Also notable over the weekend, Commerce Secretary Howard Lutnick saying that Americans should brace for higher prices when it comes to foreign goods and contending that U.S. goods will ultimately go down over the long term, but that there might be that transition period as well. So sort of this evolving rhetoric when it comes to the White House. And we look ahead to what has been shifting tariff plans. Up next, of course, John, this Wednesday, we are expecting those steel and aluminum tariffs to go into place. At the moment, we've been told not to expect any exceptions or carve-outs, although, of course, that could change. But, John, we should also be paying close attention to that these tariffs apply to downstream metal products, and that's where economists say consumers could get hit particularly hard.
So, Tyler, the next question is, are we going to get carve-outs or exemptions when it comes to some companies, especially downstream companies?
Right. At the moment, we are not expecting any, but it's important, Annmarie, that we should expect the conversation from the White House to start to shift in their rhetoric, right? We've often heard them talk about their border policies when implementing these Mexico and Canada tariffs. That conversation is soon going to shift to talking about national security concerns. So whether or not countries potentially that can prove to President Trump that they don't pose national security concerns, for example, that might end up being here. We know we're watching closely Australia, for example, one of the countries that has already started bidding for President Trump's favor, particularly when it does come to metal imports. These imports are going to hit Canada and Mexico particularly hard. We're going to have to see as it all shakes out as we get closer to Wednesday.
Tyler, appreciate it. Tyler Kendall down in Washington, D.C. Joining us now to extend the conversation, Henrietta Treyz of Veda Partners. Henrietta, welcome to the programme. A really revealing conversation with the President of the United States and Maria Bartiromo over the weekend. I took away a lot about how he was thinking about trade right now, and maybe a lot of people didn't get the answers they want, but they got answers. What did you learn?
You know, what I'm trying to ruminate around here is that the president is saying that there may be a recession this year, and he's not going to predict, but maybe that's the direction it's going. JP Morgan's saying it's a 40% odds proposition. What's really striking to me is that we are about to enact $5 trillion worth of tax policy. And effectively what the president's saying is that that's not stimulative. It's not enough to offset the impact of the tariffs. It's not enough to offset what DOGE is doing in terms of firing federal employees or trying to trim the fat here and there. I think that's the most striking part about this. Even with a $5 trillion spend, $3 trillion of which is deficit financed, there's still a higher potential of recession because of the president's foreign policy and trade agenda.
But Henrietta, also is that because they're not fresh cuts? We're just extending what we have right now in terms of policy.
Exactly. I mean, we frequently refer to these as tax cuts, but they are exactly an extension of existing policy. And all of the stimulative provisions have already been permanently imposed as a part of the tax deal in 2017. The corporate tax rate, for example. We talk about this a lot, but there's a 14 percentage point reduction in the corporate rate that was stimulative, that did generate economic feedback. And the reason inflation partially wasn't massively reported in the wake of the trade war under Trump 1.0 is because we just cut corporate rates by 14 percentage points. This time around, we don't have that potential. Indeed, some of the members on the House Republican Conference are talking about raising the corporate tax rate to 23%, which might generate $150 billion worth of revenue per point, just to offset some of that $3 trillion deficit cost. So, yeah, exactly. This is just an extension of the status quo. Hence, recession risks are rising.
Henrietta, when it comes to what Trump is not paying attention to, he continuously says, and he said again over the weekend, he's not really paying attention to the equity markets. But at what point does he need to start paying attention to the polling? Last week, a CBS poll was talking about how most Americans want him to focus on inflation and the economy, bringing prices down, something that he ran on.
I'm so glad you mentioned that. I do not buy the narrative that Trump follows the stock market. I think he follows it when it's positive. When it's negative, he blames it on foreign investors and said he's going to limit foreign engagement in the U.S. stock market. That's not consistent. Those are two completely dueling ideologies. What I think is important is exactly what you point out, the polling data. And I'm constantly stress testing whether or not Republican voters continue to support President Trump. The answer is unanimously yes. They think that tariffs are a good idea. They believe that the president has maybe some priorities that aren't theirs right now, such as, egg prices being $11 a carton, but he's focused on the agenda that he has, and they're willing to give him that leeway. Where that leeway does not exist is in the House Republican Conference or the Senate Republican Conference. And so you're seeing members sort of come out of the woodwork. Oklahoma is a perfect example. Try to get carve-outs from DOGE, try to get carve-outs from cuts, keeping the weather service open. Those are member-specific problems that do not have the benefit of the extreme popularity that Trump does. So you're going to start to see fissure between Republicans and Trump eventually.
Henrietta, I heard something different from the president over the weekend. What I was thinking about is maybe we need a lower benchmark rates in order for him to actually carry out some of his plans, including the extension of those tax cuts, which they may not be all that stimulative. This may all be by design to try to lead to lower rates, because otherwise the fiscal picture does not make sense. Does that have any validity to you?
It does, because it does generate some economic feedback. And there is a part of a corporate rate reduction that gets offset by dynamic scoring at the Joint Committee on Taxation. But it doesn't cover the full cost. So, for example, if the 1 percentage point reduction from 21% to 20% in the corporate tax rate costs $150 billion, you might get an economic feedback number in the $30 to $40 billion range. It doesn't cover the cost. It does generate some economic growth. Another good option, and something that investors are really focused on, are things like bonus depreciation extension, 100% expensing. That encourages you to go out and buy, a big piece of machinery, put it in your factory, get it to work, create new jobs, that kind of a thing. So I think you could see those pieces. The R&D proposal, the EBITDA to EBIT shift needs to be changed, and bonus depreciation is something we could see for a short period of time. I don't think a corporate rate reduction is in the cards.
Henrietta, appreciate your input as always. We're all looking for that clarity and struggling. Henrietta Treyz there at Veda Partners, struggling to get clarity on trade. Really interesting exchange over the weekend between the President of the United States and Bhatia over trade. Pressed on whether we'd get that clarity anytime soon, because that's what most officials, most people running businesses right now want. It's what they desire. They're not really too fussed if it's 5%, 10% or 15%. What's paramount at the moment is just knowing. Is it going to be 10%? Is it going to be 15, 20, 25? Tell us, then we can plan. And the president turned around and said, might go up a little bit more.
Yeah, although he then said, they always say that. That's almost like a soundbite. They always say that. We want clarity. He said, you have clarity. And then he just went on to say, essentially, you have our plan. What more do you need? And everyone's saying, well, it's a little thing about, details.
Also very telling right now, we heard from Kevin Hassett, and what he told reporters over the weekend is he doesn't like the word exemption. He said, when I go into the Oval Office and I say, what about an exemption? He goes, then I'll probably get kicked out. So maybe don't expect too many of those.
Jim Zauter of Apollo had a great phrase in the last week, macro paralysis. I think that kind of sums up where businesses right now are at, still confident, but not doing anything. And that's a problem. Coming up next, former NEC Deputy Director Kellyanne Shaw with President Trump's steel and aluminum tariffs on deck. 2 hours away from the opening bell. Let's start with equities stateside. Negative again, we're down 1% on the S&P 500. On the Nasdaq, we're down by 1.1. I just want to sit on Europe just for a beat and take a look at the German 10-year and euro dollar. We talked about this about 20 minutes ago. This is what we've heard from the Greens, that they plan to reject a draft debt package in Parliament. Initially, that took the euro off the highs and sent bond yields in Germany lower. The key part of this story, though, is that they seem to be annoyed that they were left out of talks about the debt plan, and have signalled that they do want to come to an agreement and are prepared to negotiate what they call a real reform to constitutional debt restrictions. So Germany, as far as the market is concerned, is still pointing in the right direction. It's just not going to be as easy as some people thought it might be.
Which really kind of goes to the point that they are willing to negotiate, which is actually a positive to this getting done, not necessarily an obstacle to Germany actually making plans to spend money. This is the key question. Can they go through with something that potentially is an existential threat that they need to do, or is it going to be stymied in all of this procedural and disagreement that we've seen in the region? This actually speaks more to negotiation than it does to obstacle.
I won't offer my opinion. I didn't 20 minutes ago. I'll just let the market speak for us, right? And the market's speaking pretty loud and clear. This market still believes this is going to happen, because if it didn't, you wouldn't see the euro positive on the day, and I don't think you see German 10-year yields lower by 3 or 4 basis points after rocketing higher by more than 40 last week.
If they really were looking to block this, they would criticize the spending. They would criticize the goal of it. They wouldn't criticize their particular involvement of it. They just want their say too. I'm just saying. I mean, look, everything can change, but that seems to be the tone in markets.
We'll see if that changes. Yields down just a little bit. The euro stronger on the session. With 2 hours until that cash open, let's get you up to speed on equities with some morning movers. Here's Manus Cranny. Hey, Manus.
Jonathan, very good morning to you. The laggard of the Mag 7 last week was Tesla, down 10%, down for 7 straight weeks. We start on the back foot again this morning. This is just a manifestation of the concerns around politics and production, and also within the Mag 7 as well. Dan Ives, the evangelist of this stock, buy it. Price target $550. Double your money. Roll it over. Airbnb, give you a little bit of light. This is Novo Nordisk. Excuse me, slightly out of sequence here. This is all about your weight loss trials and the CagriSema. This is the next generation of weight loss drugs, clinical trials for people with diabetes. They lost 15.7% weight loss over the period of time. The expectation, again, was higher. It was a 20% weight loss. And by the time you get to 68 weeks of using the drug, well, 2/3 were on the highest dose. Now we'll have a little bit of Airbnb. In the midst of all this recession talk, in the midst of all this growth slowdown, and this wealth effect that we're talking about, Airbnb, you've got one out there, Jefferies, upgrading the stock to a buy. Durable growth, 38% upside. Price target, $185. Who's calling recession? Jonathan.
Not me, Manus Cranny. Manus, thank you. More from Manus a little bit later on this morning. On our radar this morning, President Donald Trump reiterating there will be growing pains as his policies go into effect.
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time.
Will there be a recession? I won't forecast that. There will be a period of transition. It takes time.
It takes time. And what you're hearing from the president, what you've also heard from the Treasury Secretary, Scott Bessent, is that, one, they are preparing the American people for this, and two, they think it's necessary for long-term gains to have this short-term pain. The issue I have with all of this is not even what happens in the financial markets, but at some point, do you start seeing a lot of this turn up to polling, especially to your point, Lisa, if you see people being laid off and the scars that leaves?
Right now, you're not. And actually, Nate Silver of 538 came out with a poll, and it showed Donald Trump's approval rating at about 48%. It's holding in there pretty much in line, maybe a tick or two lower. But I've been watching those polls, too, to see if they've been shifting, and they haven't been. And that, I think, is telling. He still has some leeway to go. And that really is the reason why it's hard to see why he would take a step back from this approach.
And at the index level, we haven't had a massive gap lower just yet. We might in the future, but at the moment, where are we at? 6-7%, something like that on the S&P?
Right. It feels more dramatic than it is. That said, Wall Street already is downgrading their forecasts pretty significantly. And you're seeing that across the street. You're seeing that Goldman Sachs now a 20% chance. On Friday, they said of a recession. You saw a 40% chance put out there by J.P. Morgan. There is a sense that things are shifting, and they're shifting very quickly.
Saw the same thing from Mike Gapon last week of Morgan Stanley, dropping his growth forecast, increasing his inflation forecast. Let's get you the latest elsewhere. Elon Musk urging the US to exit NATO, saying it, quote, quote, doesn't make sense for America to pay for the defence of Europe. His comments coming as NATO's future hangs in the balance.
So this is a lot of consternation between NATO allies because of that man right there, Elon Musk, the proximity of power he has to President Donald Trump. And last week in the Oval Office, when Trump was asked about NATO, he said, do you think they're going to come and protect us? They're supposed to. I'm not sure. What I take from all of this is the fact that there's two things that we do know. We do know that the United States is pressuring NATO allies to spend more, 5% of GDP, which, by the way, the United States doesn't, but maybe they're going to get to. The other thing, last week at the Economic Club, I was struck by what Scott Bessent said. He said that increased burden sharing on security is critical amongst friendly nations. He sounded like Jonathan when he said this. No longer should American tax dollars, American military equipment, and in some cases American lives be the sole barriers of holding up friendly trade and mutual security. Basically, we are no longer going to fund these social programs that Europe has the blessing of having because of the U.S. defense.
If people were worried about the Green Party stymieing any negotiation in Germany, this just basically pushes them that much further. You know, if the U.S. drops out of NATO, Green Party wants this, okay, give it to them. You know, let's keep going.
You ever seen that meme? You're about to find out why America doesn't have socialised healthcare.
Yes.
It's those pictures of, like, fighter jets coming through and aircraft carriers.
Uh-huh. Yeah,
that's what that's about. I think that speaks to this story perfectly.
Very much
Europe
so.
has nice trains. Europe has nice socialized healthcare. And we have a, $800 billion defense budget.
Do you know how popular Doge is, just to mention Elon Musk? I was at a concert on Friday, comedy show, Barclays Centre. Doge and Elon Musk gets a shout out. 20,000 people, raw. So much support for some of the policies coming from Doge and the general public.
The concept of reducing waste, of becoming more efficient, is hugely popular, and it's something that a lot of people should embrace. Question really remains how it's being done and whether it's going to be effective, and frankly, whether people who are affected by it are going to feel the same about it. And I think that that's really the key question as this unfolds.
Sebastian Maniscalco said, I want Doge to come to my house.
Yes, well, yeah. And,
yes.
And deal with what?
We'll talk about that another time. President Trump saying he's negotiating with 4 possible buyers for TikTok's US business. Trump didn't specify the contenders and didn't say if he's leaning in a particular direction. This story, front and centre.
Front and centre because guess what? The clock is ticking, literally tick-tock. Deadline of April 5th. Although there is a caveat. Trump could extend it. He could give all these parties a little bit more time when it comes to negotiating, but more people keep throwing their name in the ring when it comes to who wants to take over TikTok. Then you have to remember, of course, Beijing has to sign off on it. That's a big problem.
True. It's a big hurdle. Let's turn back to the tariff agenda. 25% tariffs on steel and aluminium imports still on deck for Wednesday. The former NEC Deputy Director Kellyanne Shaw writing, the ambiguity of Trump's tariff plans are a feature and not a bug, as he sets to negotiate both USMCA and relationships with a number of key trading partners. Kellyanne Shaw joins us now for more. Kellyanne, welcome to the programme. Those negotiations set to kick off a whole lot more in the next month, at the start of April when we get the reciprocal tariffs. What are you expecting to see in the next month or so?
Yeah, good morning. I think what's been really interesting is despite the fact that last week's tariff action on Canada and Mexico was the single largest tariff action of any president in modern history, the administration keeps saying, hold your breath and wait till April 2nd. So I'm expecting the announcement of large tariffs on a number of U.S. trading partners, particularly those with large trade deficits, which will give them an opportunity to potentially negotiate their way out of whatever the administration has planned in terms of rebalancing those trading relationships.
Kellyanne, when it comes to April 2nd, is this just the announcement and then we're going to have a public comment period? How long until we see the tariffs actually take place?
Yeah, the truth is we don't know yet. We're not clear on how the administration intends to structure this, whether they intend to actually move forward with tariffs under something like IEEPA or Section 338 on April 2nd, as well as some of these sectoral tariffs that they've been talking about, or whether they'll announce their plan and then kick those off into investigations, which would take several more months before those tariffs went into effect. They could pick either path.
If it's a path that they're going to have some more time, does that mean that Trump is in negotiating mode and he's happy to maybe pull back the tariff threat if he gets something from one of the trading partners?
Well, I think the president has been clear that he is open to negotiations on these reciprocal tariffs. His idea is that we'll charge you what you charge us, and if other countries come to the table and lower their own tariff barriers, then those tariff rates would go down on the U.S. side as well. And I think that is the beauty of this concept of reciprocity. It really is the epitome of fairness from the perspective of the president. So I certainly think there's scope for negotiation.
What about Wednesday when it comes to aluminum and steel? Do you expect those tariffs to go through, as Howard Lutnick said over the weekend?
Yeah, I do. I think that this is a redo of what the administration did back in 2018. And the view that you're hearing coming out from the White House is that there were so many exceptions, so many exclusions, that it became a loophole you could drive a truck through. And so they're starting with the maximalist tariff approach when it comes to steel and aluminum. I do think that there is scope for countries like Australia or maybe Canada and Mexico to get some sort of country exception, country exclusion. But for now, I think he's moving forward with the full measure.
A number of studies, Kellyanne, have been pointing to the fact that actually production might move more quickly out of the United States if the 25% tariffs do continue, particularly on Canada and Mexico. I'm talking about auto parts makers in particular. How much do you think that the president accounts for this type of behavior at a time where a lot of companies are trying to insulate themselves from headline risk?
Yeah, I think that the president's reaction to pare back some of the Canada and Mexico tariffs and say that for companies that are complying with USMCA rules of origin, that you would be exempted from the measure shows that the president is paying attention to this and that it's not just about production in America, but in North America. But this is an administration that is really focused on production. And so not only are they using tariffs to achieve that, but they have forecasted that when it comes to tax cuts, deregulation, and a number of other policies, they're going to do what they can to incentivize producing in the U.S. and producing in North America.
Kellyanne, what do you make of this theory that this is all by design, that a little bit of pain is kind of the goal here to get interest rates lower, to offset some of the tax cuts and just the increasing deficit and increasing interest expense that the U.S. is paying? Do you believe that that could actually be by design?
I'm not sure if that's the objective of the administration. I think when they talk about the fact that there's going to be pain and when the president talks about this transition period, what they're talking about is the fact that they have their eye on the ball 10 steps ahead. And that at the end of the administration, they want to be in a place where U.S. trading relationships are in a more balanced position, where there are lower tax rates and there is a greater incentive to produce in the United States and what they refer to as this golden age of manufacturing, golden age of production, but that is not going to be easy to get to. It's not a straight line. You're going to have to break some plates in the meantime. And so if some of these other economic consequences are happening, that is part of the entire measure, but I'm not sure that all of these are necessarily intended consequences.
Kellyanne, there's one place we know where the tariffs are going to stick, and of course that's China, 20%. And as of today, China's reciprocal tariffs on the United States, those retaliatory measures have gone into place for a number of agricultural products. Given you were there for phase one, do you think potentially there's a bigger deal to be had at the end of this when it comes to China? Because I remember in 2018, there was billions of dollars of losses from the agricultural sector in the United States, and then Trump had to actually have a bailout for these farmers.
Yeah, agriculture really is at the tip of the spear when it comes to trade and tariff policy because they're the first to get retaliated against. They are one of the most politically sensitive products in the United States, and every member of Congress has some form of agriculture in their district, which is why it's so attractive for our trading partners to hit them first. We'll have to see where this goes. I mean, the president has tweeted and posted on True Social about taking care of the farmers, having them sell domestically. I think he is keenly aware that they are getting hit first. But when it comes to China and some sort of trade deal, the jury's out. We'll have to see what happens and whether China wants to come to the table with the United States and vice versa. April 2nd, the president has a report on China's compliance with the phase one deal, a review of the $18 billion in tariffs that the Biden administration added, and then China's IP practices. So I fully expect this relationship to get a bit more tumultuous before it gets better. And then maybe this spring or summer, there might be some scope for negotiating some of it back down.
Well said. Kellyanne. Good to see you as always. Kellyanne Shaw there, the former NEC Deputy Director. We get the tariffs potentially on steel and aluminum this week. Then next month it's reciprocal tariffs time, which we're told by the administration will be the big one. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President Trump is set to meet with CEOs of major tech companies at the White House today. That includes HP, Intel, IBM, and Qualcomm. The meeting will focus on trade policy and U.S. manufacturing, with mounting questions on expected policy changes. That including tariffs and stricter export rules that could impact the tech industry's global supply chains and operations. A U.S. negotiator says a new Gaza ceasefire deal is possible within weeks. Adam Boehler told CNN this weekend the possible agreement could even see Israel recover all hostages held by Hamas. A 6-week truce expired earlier this month, with both sides divided on conditions for more suspension of hostilities. And a check on Novo Nordisk shares, those down 6.4%. That's the most since December, after the drug maker's next generation shot, CagriSema, showed a 15.7% weight loss in a clinical trial of people with diabetes. Patients were allowed to choose their dose of the medicine, and after 68 weeks, less than 2/3 were on the highest dose. Shares have fallen 37% in the past 12 months on investor concerns that Novo won't be able to compete with competitors long term. And that's your brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, separating signal from noise.
While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their likely effects remains high. As we parse the incoming information, we are focused on separating the signal from the noise as the outlook evolves.
The chairman of the Federal Reserve in no rush to cut interest rates. Up next on the programme, Michael Zezas of Morgan Stanley from New York. This is Bloomberg. Extended losses going into the opening bell. We're negative here by more than 1% on the S&P. On the Nasdaq 100, softer also, down another 1.3. Under surveillance this morning, separating signal from noise.
The new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their likely effects remains high. As we parse the incoming information, we are focused on separating the signal from the noise as the outlook evolves.
For the first time, the Fed Chair Jay Powell tackling some of these issues head on, reiterating the Fed's commitment to its wait-and-see approach. Michael Zezas of Morgan Stanley writing, there's a near-term cost to the economic transition the US is pursuing, and fiscal policy may not be much of a mitigant. Michael joins us now for more. Michael, good to see you.
Yeah.
That last line, what are you suggesting here?
Well, I mean, with fiscal policy, we're looking at it as mainly just an extension of current policy. If at the end of the day, most of what you can get done is extending the expiring provisions of the TCJA, and maybe a couple of other things, we think they can get, for example, domestic manufacturing tax credit in there, but there's probably going to be some pay-fors to offset on that. You're kind of just taking current policy forward in the aggregate. So what you're experiencing right now is obviously impacting growth in a challenging way. When fiscal policy comes along, there's not a lot of reason to sort of lean on it and say, hey, it's going to start pushing things in the other direction.
When you say manufacturing credit for domestic producers, do you mean a lower tax rate if you produce in America?
Well, effectively, that would be the result, right? If you take that credit because you're fully manufacturing in the U.S., then you're paying a lower effective tax rate, which I don't know if that's a distinction, perhaps without much of a difference. We don't think they're actually going to create a separate tax rate and a separate tax structure.
What happens to things like no tax on tips, no tax on Social Security, all these extras Trump was throwing out during the campaign trail?
Yeah, I mean, right now, we don't have either of those things in the baseline, largely because we don't think that Republicans have a very slim majority, right? So we don't think that they're going to be able to tackle and bring forward enough pay-fors to actually fit inside of the budget reconciliation shell that they have. And in particular, that budget reconciliation shell kind of calls for a whole bunch of spending cuts that, again, we don't think they're going to be able to materialize or get enough votes to get through.
So what I'm getting from you is that even if we eat our vegetables and the dessert comes, it's not really dessert. There's nothing going to be that exciting for this market. It's just an extension of what we currently have, status quo.
I think that's mostly right. I mean, within that, there are probably some sectoral elements that are beneficial. But yeah, for the most part, we're taking current policy and we're extending it forward. It's obviously better than if we just let all those tax cuts expire, but it's not a stimulus per se, right? So to talk about it in stimulus terms, I think would be the wrong way to think about it.
I think we need to give vegetables a better name. We'll work on that a little bit later. I'm actually trying this morning. Michael, you wrote this, and I think it's a really important point. You may be constructive on the transition the U.S. is trying to effect, but the execution risks and potential costs are hard to ignore. The outlook is skewing more favorable for bonds over equities.
Yeah.
Just can you give us a sense of the execution risks that you see on the horizon that seem to be very worrying to Wall Street, but frankly, that aren't hitting the popularity of some of these programs yet in the polls?
Yeah, well, it's because we haven't really realized or experienced a lot of the impacts of some of these tactics, right? So the Trump administration has some clear goals about what it wants the economy to look like. It wants it to be more industrialized, wants good trade deficit to be lower, it wants more secure supply chains. You might completely agree with those goals. That might be what you think is the right endpoint for the political economy. The tactics you're using to achieve that and kind of speed it up, by the way, those goals were not necessarily not shared by the last administration. The Trump administration wants to move it faster using tariffs. The execution risk there is what we're talking about, what our economists are talking about, which is lower expected growth this year. We just marked down our GDP forecast to 1.5 real growth this year, 1.2 for next year. And so that's the execution risk, right? You have to accept lower growth in the short term. And then, of course, what we don't know is kind of the reaction function from the rest of the world and how that comes back to impact the U.S. So, again, this might be a transition you agree with, but it does cost something, and we have to deal with it in the short term.
There's a theory that the U.S. was on a collision course with its interest payments that was going to become so damaging that it would have created a crisis anyway, and that if you didn't have lower 10-year Treasury yields, that you'd be running into a real problem in the near term, especially if you wanted to pass an extension of these tax cuts. Are you sympathetic to that view?
Well, first of all, it's hard for me to know if the administration really is sort of pursuing that as a strategy or if that was a strategic concern of theirs. But I don't think there's anything intrinsically problematic in the near term about the U.S.'s fiscal posture. And so, for example, if we're just extending current tax policy, you're looking at something like deficit stability in the near term. So I think the policies we're seeing are a lot more about achieving those kind of restructuring goals. And the net effect of that is lower growth in the short term. You're probably going to get a more dovish Fed, at least in 2026. That's ultimately what pulls yields lower, and that's why we're more constructive on bonds at the moment than we are in equities.
Michael, what does that mean for the shape of the curve, the overall shape of the yield curve?
Yeah, well, in the near term, it should mean that the shorter end of the curve stays a bit higher in yield because the Fed has to do less than we previously expected in terms of being dovish because they have to look at the incoming data, make sure that what we're seeing in inflation from tariffs isn't a sort of permanent thing, make sure they feel comfortable it's somewhat temporary. But then we get into 2026, you should see the short end come down. But meanwhile, the 5 to 10 year point reflecting growth concerns should continue to come down lower in yield.
It just turned in last year upside down. Towards the end of last year, post-election, when we had this big steepener come through, and then this flatness just started to take control through 2025.
And it really just matches the idea that people had expected an acceleration in growth at the end of last year, and now it's the opposite. Do we get a reinversion of the yield curve, and what does that say at a time when potentially this is an administration targeting 10-year yields, not necessarily jawboning the Fed?
Michael, it's good to see you, as always. Michael Zezas of Morgan Stanley. Lisa, you nailed the question, is it by design? It's something a lot of people are talking about right now, that's for sure.
You have to imagine that at a time where the deficit is the biggest concern facing an administration that wants to cut taxes, that wants to engage in some of the sweeteners, you have to think, well, it is convenient that you do have yields coming down. And I will say this, in that interview with Donald Trump over the weekend, when Maria Bartiromo asked him, are you concerned about inflation? Trump said, you may get it. In the meantime, guess what? Interest rates are down.
They're down again this morning. Bond yields are lower by 6 basis points. The 10-year 4.24. On 30s, we're down 5. On the 30-year maturity, we're down to 4.55. Up next on the programme, in the third hour of Bloomberg Surveillance, we'll catch up with Barbara Reinhard of Voya Investment Management, Gerard Cassidy of RBC. The banks have been absolutely hammered over the last week. We'll speak to Dutta of Renmark and Ashok Bhatia of Neuberger Berman from New York City. This is Bloomberg.
We came into this year with such high valuations, such stretched expectations that there still is very little room to absorb any kind of bad news.
It's clear that we do have a lot of headwinds mounting.
I can go across the board. Every single consensus trade has been upended.
Risk assets are very vulnerable.
This risk of something deeper than a 10% drawdown, that is rising.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
90 minutes away from the opening bell. Your third hour of Bloomberg Surveillance starts right now with equity futures negative by 1.2% and your week ahead shaping up as follows. Later on this week, CPI on Wednesday, PPI later in the week, so you get another read on inflation in America and another deadline for tariffs, this time 25% on steel and aluminum.
And what we heard from Kellyanne Shaw earlier, formerly of the Trump administration, was that she does think those are going to go on, and it raises the question of what the ramifications will be. When you look at the week ahead, I love what Stuart Kaiser said. He said, Michigan is oddly important at a time we're trying to gauge very quickly moving information, and sentiment is suddenly renewed importance.
So this is the soft data, and I think we're all sitting here waiting to see whether any of that uncertainty, the lack of clarity on trade, spills into the hard data. And so far, things are just about okay. On a headline basis, payrolls were just about okay.
Just about okay, but then you look at what CEOs are saying, and they're talking about the fact that this is going to be challenging. How do they digest this, and how much are they going to be passing on to consumers? And remember, when it comes to Wednesday, the 25% on aluminum and steel, which Howard Lutnick over the weekend said is going to go through, Steve Chiavarone said that's not even peak uncertainty when it comes to tariffs. We still have an entire month to wait. April 2nd is when we'll get the outline for those reciprocal tariffs.
The president was pressed and asked for clarity on trade, and he said tariffs might go up.
They might go down. So basically, he isn't going to give any clarity, and that's by design because that's a negotiating feature. In the meantime, though, what do businesses do? And how much can they engage with some sort of spending package or some sort of execution plans if they have a lack of certainty? That's the reason why tomorrow the NFIB Small Business Optimism Survey is going to be also very important. Do you start to see that shift come out in that data?
The confidence into 25 was sky high. And we sat around this table and said it. We want to see that translate into better hiring. We wanted to see that translate into more investment. And you just keep hearing the same thing over and over again. Wait and see. Pause. Wait and see. Even the chairman of the Federal Reserve is effectively telling you we're going to wait and see. We're not in a rush to cut interest rates. I'll go back to that quote that we heard from Jim Zelter of Apollo. Macro paralysis. I think it's a perfect quote. Just a concept to really think about. That's the moment we're in at the moment.
Paralysis is a decision, and that's something that you made the point of last week, which is if you have a lot of inaction that has consequences and it's going to start showing up in the data. It's the reason why it's difficult to really look at backward-looking data and use it as a benchmark for what's to come, and the reason why it's getting a lot more choppy.
Kevin Hassett, though, Jonathan, on Friday said to you, pointing to the gains that are set to come. Basically talking about we need the deregulation train, we need the tax cuts, or just the extension of TCJA to make sure they hit the ground running to really offset what we're seeing in this uncertainty when it comes to tariff policy.
Good data is Trump data, bad data is Biden data. Are we clear on that now?
Sure.
Commerce Secretary Howard Lutnick went crazy about this. It's not my president's data. And then Kevin Hassett comes on with me on Friday and says, we're making changes already and you're seeing the benefits.
And then Donald Trump goes on TV over the weekend and says, if there's pain, there's pain, because what we're looking for is long-term gains. So at a certain point, does it even matter? And this is one reason why it is very difficult to get a handle around this economy, whether it's Trump data, whether it's Biden data, because ultimately it is a quickly moving economic backdrop.
And the market's moving on it. Equity futures right now down by 1.2% on the S&P 500. Coming up this hour, we'll catch up with Barbara Reinhard of Voya as stocks look to rebound from their worst week of the year. Gerard Cassidy of RBC on the sell-off in financials. The banks hammered through last week. And Neil Dutta of Renmac on risk to the labour market. We begin this hour with equity traders looking at futures lower as traders weigh growth concerns. Barbara Reinhard of Voya Investment Management writing, it's challenging to have strong views in this turbulent market environment. If the prior Trump administration is guidance, ratified trade policy should be better than feared. Barbara joins us now for more. Barbara, good morning.
Good morning.
Is that playbook even worth looking at anymore?
I think the problem is the stop and go nature of the administration's policy seemed to really be what's causing a lot of indigestion in the markets. And that also coupled with softer survey data, earnings revisions have been marked down a bit, at least for the first half of this year. And it's causing a lot of problems. I mean, it was just on February 20th that we hit a new all-time high for the S&P 500. It feels like it was about a year ago.
Things have changed quickly. The president's not stepping in. He's not changing course. It's early days. Why would he? The chairman of the Federal Reserve is not stepping in or changing course. What do you need to see to generate a counter-trend rally here? What needs to happen?
Markets are very oversold at this point, right? So we have long-term indicators and short-term indicators on investor sentiment. And our short-term indicators are as oversold as they have been in over 3 years at this point. You'd have to go back to the 2022 sell-off to have this type of short-term oversold indicators. I think that you probably need some clarity on tariffs in order to be able to get the market to be put in a sustainable rally. Now, when a counter-trend rally comes, what's likely to do well? The things that have sold off the most. I mean, U.S. small-cap stocks, someone on my team pointed this out to me, are down over 20% from September or 2024. So likely you're going to see a big counter-trend rally in U.S. small caps, U.S. mid caps, potentially U.S. growth stocks as well. But it could be a while before you get enough visibility to generate that counter-trend rally.
You said that the oversold indicators were the most going back to 2022, and yet we're still at some 21 times earnings. We're still at a pretty elevated valuation, which goes to the structural argument that maybe money has been flowing into the U.S. disproportionately for so long that now just a normalization, especially back to Europe, makes a little bit of sense. How much credence do you give that idea?
I don't discount it all that. I mean, I give it a lot of credence. However, I would note the following. The fiscal stimulus plans that Germany is planning to put into place is really only for Germany at this point. You still have long-term structural issues that have to be solved for Europe, according to the Draghi report. You have demographics that are working against you. You've got regulation that is very heavy in Europe. Those things have to be addressed and changed dramatically in order for Europe to say, Europe's going to outperform the U.S. for the next 3 years.
One difficulty right now is you don't invest in hours, right?
No.
I assume that you have a longer-term horizon.
Yes, I mean, I'm investing for retirement. My horizon is technically 40 years.
So this is the difficult aspect, right? This is a trader's market right now. We're talking about shifts that are incremental when you have to look over the big term and understand what the long-term goal is and whether it's feasible for us to get there. So how are you doing that?
Well, I think the big issue that we're considering now is that the stagflationary scenario is getting a lot of traction in the markets. And if that's the case, no asset class works. Not bonds, not stocks, not international, nothing. Well, maybe cash works for you over the very short term. Now, if you get a little bit less policy uncertainty, you can look a little forward to the U.S. data seems to be softening a bit, at least on the survey side. If it starts to reach the hard data, such as employment, you would see a Fed policy response if they have the air cover on inflation. But the problem is that even with the change in policy on Friday, you did not see this big rally off of, we're giving some relief on tariffs that you had seen before. So I think the market is in very much a show me state. And the only way that you get there is clarity on inflation and clarity on tariffs. Neither of those seem to be coming. Now, having said all that doom and gloom, I could potentially see a very good case that the Fed has the ability to cut rates in the second half of this year, maybe really in kind of like the late third quarter, because if all goes well, if tariffs are indeed staved off, it's a one-time inflation hit to the upside, you should get enough relief from weaker economic data that inflation's coming down, that core PCE is dropping, that the Fed may be able to say we can cut interest rates maybe twice this year. That should give the market enough relief as long as the underlying earnings picture stays pretty much intact.
The narrative is focused on the political economy and all these headlines from Trump. So you're saying that it can shift back to the Fed and that could be the catalyst for an upswing in U.S. equities?
It could be an upswing in equities globally at that point. I think that you need to see at least some policy certainty from the administration. And don't forget, as we get towards the second half of this year, they have to start worrying about the midterm elections in 2026. So the clock on the very difficult, very uncertain Trump policies that could be growth negative do have somewhat of a time decay associated with them.
We do have some certainty, though. Tariffs have gone into place on China. Are you saying potentially uncertainty on everything else is almost worse than tariffs going into place?
Well, tariffs in place on China is really an old story that's been coming through for a long time. So what happened after the first tariffs went in on China, you had this opportunity set where the rest of the world stepped in to be the manufacturer, right? So countries in Asia, Thailand, Malaysia, the Philippines, and also even to Mexico. When you're starting to talk about tariffing our two biggest trading partners, that is a whole different story. Those will certainly put Mexico and Canada into a recession. And they account for 40% of globally traded goods. So it's a very different story to tariff China and then thinking differently about and with the Mexico and China and then also potentially Europe. If you tariff Europe, that's going to have a big knock-on effect to China as well. However, the biggest swing that you can get in stimulus is likely coming from the Chinese. So that actually makes us a little bit more bullish on the emerging markets than we would say the very overbought European equities at this time.
So you put this all together. It sounds like on the margins over the past few weeks, you've been shifting out of the U.S. and waiting for the U.S. to sort of get some of those certainties before going into whether it's small caps, mid caps, or big tech. Is that the idea?
Well, in our portfolios, what we've done more recently, we bought a little bit more into the emerging markets. We bought something into U.S. mid caps because we want to make sure and have exposure to those parts of the market that are likely going to benefit from the rotation. We've been reticent to buy European equities because they have run so far at this point. Every single type of technical indicator that you look at, RSIs that you can look at on your Bloomberg terminal, and many of our sentiment surveys say that European equities are indeed overbought. So if you're buying them at this point, the potential tide is against you just because the news has been so positive for Europe. So we would wait for someone to have a reprieve before we would think about going out to European equities.
The DAX is still up about 20% so far year today, even with the 1% move this morning. Barbara, it's good to see you. Thanks for breaking it down. Thank you so much. Barbara Reinhard there of Voya Investment Management. If you are just joining us, equities here down by 1.4% on the S&P 500. Lisa, just a snapshot of Wall Street over the weekend. Ian Lincoln of BMO. Nothing to point towards stability in the near term. Cameron Dawson of New Edge, good friend of this program, expect volatility, get used to volatility simply because there's no cushion, no margin for error.
Yeah, Ed Ardeni raising their recession odds. We spoke to him about that. Ed Ardeni saying that Trump 2.0's head-spinning barrage of executive orders, firings and tariffs are causing him to lose some confidence in the potential melt-up that he had been talking about before.
And the roaring 20s he's been talking about for the previous 4 or 5 years. In the bond market, bonds are bought, yields are lower. We're down by 6 basis points on a 10-year to around 424. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. It's Danny Berger. Hey, Danny.
Hey, John. Trade tensions between the U.S. and Mexico are simmering. Mexico's President Claudia Sheinbaum said that she is confident the U.S. will not impose reciprocal tariffs on her nation's exports. Prior to her comments on Thursday, President Trump said that he would pause the 25% tariffs on Mexican goods and services that fall under the USMCA. The Prime Minister of Greenland said that President Trump is making residents of his country feel unsafe with his threats to take over the island. Greenland is facing an election tomorrow. Most parties have campaigned on moving closer to independence, and opinion polls show an overwhelming majority don't want to become part of the U.S. And in sports, it was a busy weekend of NFL signings. The Browns signed defender Myles Garrett to a record extension, making him the highest paid non-quarterback in NFL history. Reigning league MVP Josh Allen agreed to a $330 million contract with the Bills, which includes a $250 million guarantee, the most in league history. And that's your brief, John.
Danny, thank you. More from Danny later on this morning. Up next on the programme, the Morning Calls Plus. Gerard Cassidy of RBC. With weakness in the banking sector, the KBW Bank Index down almost 9% last week. We'll talk about why and what's next with Gerard in just a moment. From New York City, this is Bloomberg. Three weeks of losses on the S&P 500. Haven't seen that all year. Biggest weekly loss of the year so far. And this morning, as we kick off a brand new trading week, we're down again by 1.4% on the S&P, lower by 1.6% on the NASDAQ. Let's turn to some morning calls. First up, Jefferies upgrading Airbnb to buy, citing durable growth. That stock this morning, it's positive by just 0.04%. Your second call from Bernstein, lowering its price target on United Airlines, expecting uncertainty to weigh on the industry. That stock is down by 2.5%. And finally, Raymond James, cutting its price target on Oxy to 64, citing near-term uncertainty on oil prices. That stock just a little bit softer in the pre-market. Let's turn to the financials. They were a whole lot softer last week. Bank stocks this morning extending declines. The sector, the worst performing on the S&P 500 last week, falling more than 5%. The KBW Bank Index down by almost 9%. Gerard Cassidy of RBC joins us now for more. Gerard, welcome to the programme, sir. Let's talk about the pullback in the financials. Which kind of banks are finding it more difficult in this environment, and what is it about this environment that is proving tough for these stocks?
John, it's really coming down to the outlook, the increased uncertainty caused by, the tariffs that the president offered up with Canada and Mexico, of course, early last week has really caused a lot of uncertainty on the growth of the economy. But specifically, John, the capital markets investment banking activity has gotten off to a slower than expected start, particularly in the ECM, equity capital markets, and the advisory business. So that has been impacted, I think, mostly with those banks that are in that business. So it's the uncertainty and then the weakness in investment banking that caused, I think, that decline you just talked about last week with the bank stocks.
Let's just sit on that activity, Gerard. Do you think that is activity that is disrupted, that might not happen now, or just delayed for a number of months, a number of quarters?
It's interesting, in our RBC's Financial Institutions Conference last week, the banks that had the investment banking activity talked about it. The pipelines are still full. So it's really more of a delay at this point rather than business going away. So to answer your question, I would say it's more of a delay, possibly second, third quarter, as things hopefully calm down after what we saw last week from the White House.
Gerard, at the conference, when you say hopefully calm down, what could happen for these deals to actually come to fruition at a time where we haven't yet maybe reached peak uncertainty?
I think what we need to see is that the economy continues to grow, continues to be healthy. When you think about M&A activity, management teams have to have confidence that the economy will not be heading into a recession before they enter into a merger or acquisition. So I think once we see more economic detail as the months go by, giving these management teams confidence, that's what I think we need to see over the next 2 to 3 months.
Gerard, we heard from President Trump himself over the weekend that he's not ruling out a recession, that there is going to be a little bit of pain as they make this big adjustment. And at the same time, we have seen this administration celebrate the fact that longer-term yields have gone lower. At what point are those lower yields supportive for some of these businesses and for some of this M&A activity that still is in the pipeline?
Lower yields would certainly, I think, accelerate some M&A activity. It also would accelerate, the housing market. If we were to see the 10-year government bond fall below 4% and you start to see spreads come in on mortgage-backed securities, that would certainly stimulate the housing activity, certainly refinancing activity. But to the M&A question, lower rates would certainly make deals more attractive, and that could get people to jump off and start doing more deals in the second quarter going into the early part of the summer.
On the flip side, what we're seeing, as John was pointing out earlier, is the reverse of last year, which is the steepening yield curve trend has now turned into a flattening yield curve, with the long end declining, yields declining in the face of potential growth concerns, while short end yields remain pinned. This is hugely problematic for the banks. I mean, at what point does that itself really fly in the face of this ongoing rally?
It's a good point, because coming into the year, the banks were set up very, very well. The regulatory outlook is really going to improve for the banks. That was number one. Number two, you had a healthy economy. Number three, interest rates. And as you pointed out, we'd had a positive yield curve, which we hadn't seen in quite some time. As the yield curve flattens, it's less positive for the banks. So it's really going to be interesting to see what the Federal Reserve does, because if the economy is slowing and there's no real threat of inflation, if they could lower the short end of the curve and create that positive yield curve as the long end comes down, that would certainly be positive for the banks.
So, Gerard, what would you buy? What are you telling clients to do right now? There are pure capital market plays that have been beaten up a bit. The bigger banks, the likes of Bank of America, the likes of JP Morgan, are down some double digits as well. JP Morgan down double digits, down 13% from the highs of only a month ago. What are you kind of thinking about at the moment, and what are you telling clients to do?
John, when you look at the valuations, the banks are really becoming quite attractive. Not to say that they weren't attractive before, but Bank of America is a very good example of a way of playing the economic expansion through the consumer and small business. But at the same time, they have, of course, the capital markets business with Bank of America Merrill. So that's one way of playing the banks, is through a large money center such as Bank of America. Then on the regional front, the regional banks are still doing well, and we point people toward the likes of Fifth Third or Key Corp or Regions Financial as a way of playing the regional banks. Now, these are more risk-on names, and if people wanted to go into a risk-off position with commercial banks, then would steer them to a PNC or an M&T Bancorp.
Gerard Cassidy of RBC. Gerard, appreciate the update, sir. Lots to think about. What a sector to be in at the moment. The financials, really difficult week last week. We talked about the banks on the S&P down some 5%. KBW Bank Index, to see that move, down by almost 9%. And if you just track the chart back to where we were post-election, we're very, very close to raising the post-election gains. And this was one of the favoured sectors coming into 25.
It's pretty much a reversal of everything that we saw in the first couple of weeks after the Trump administration. I mean, even beyond banks, take a look at Tesla. It's sort of the poster child, where it's down almost 50%. With banks, there is a question of whether this is just simply tracking the sentiment shifts or whether this is actually a repudiation of this idea that we are going to get some sort of boom in M&A. We're going to get some sort of boom in the fundamental American economy. That still has yet to be seen. And that, I think, is the reason why Stuart Kaiser was saying this is the tell that this economy is actually rolling over, that the bear market could come if this keeps selling off.
Consensus view for Gerard, I think at the moment still believes that we'll get that activity. That activity is just delayed. And that's a problem in the near term for us all to try and grapple with. You mentioned this earlier, you alluded to it, and I think it's important. Once you start to unlock some weakness, though, does that weakness get away from you? That could be problematic. And we're seeing that from some of the calls now on the street. I mentioned Morgan Stanley and Mike Gapin dropping their growth forecast, increasing their inflation forecast off the back of some of the policy changes we've seen in just the 1 month we've seen, the one full month we've had from the administration. This comes from Goldman this morning. They've updated things in the past week as well. New tariff assumptions imply that core PCE inflation will rise a bit and peak at about 3% year on year versus remaining roughly steady in the mid-2s previously. So that's inflation, stickier, higher than anticipated. On GDP, larger tariffs also likely hit GDP harder. We've reduced our 25 Q4 GDP growth forecast to 1.7% from 2.2. So just directionally, things are moving in the wrong direction when it comes to the outlook in the United States versus moving in the right direction over in Europe. Now, you could still get to the end of the year where growth in America is better than growth in Europe, but where we're moving directionally, where we're pointing, is important.
And that's the reason why the dollars are flowing in tandem with that. How do you invest in uncertainty? And a stagflationary light type of environment, which is what you described and what Goldman Sachs seems to be shifting their expectations to, isn't good for any assets. So why try to play? Question is whether this is just such a quickly whipsawing narrative shift that people are getting over their skis with excitement over Europe, which still faces a lot of structural and demographic challenges, and perhaps leaving the U.S. to the dust. There still is a long way to go, though, given how expensive U.S. stocks have been and how much the dollar long has been entrenched in global investing for the past decade.
I feel like I'm always the first to say there'll be teething problems in Europe. It's going to be nothing easy about this. We've seen that taking place in Germany already this morning. But the outlooks at the moment are moving in the right direction for Europe. And at the moment, at least, and things can change, they're moving in the wrong direction for the United States. We heard from HSBC this morning, downgrading their view on US stocks to neutral and upgrading their outlook for European equities. And we've already seen a monster move over the last month or so. This morning at session lows, we're down by 1.4% on the S&P 500. A big week still ahead for economic data. CPI on Wednesday, PPI after that, and another deadline for trade. 25% tariffs on steel and aluminum on deck this week. Up next on the programme, we'll speak to Neil Dutta of Renmark about the economy, and we'll speak to Ashok Bhatia of Neuberger Berman, as Trump Volume 2 apparently is good for bonds and bad for stocks. That conversation up next. "60 minutes away from the opening bell. Here are the scores for you. Equity futures down by 1.4% on the S&P 500. On the Nasdaq 100, we're down by 1.7%. A lot of pain for tech once again this morning. As we count you down to the cash open, let's get you some morning movers with Manus Cranny. Hey, Manus.
Jonathan, good morning. And we did have a technical correction on the Nasdaq last Thursday. We spun it around. But Tesla is the personification of the pain in the Mag 7, down for 10% last week, 7 straight weeks. We're on the back foot again this morning. This is 5 months of pain for Elon Musk. Still, you got to look through it, Dan Ives says over at Wedbush, the evangelist, $550. So there's a bit of a double bubble there for you. Novo. This is a big one, Jonathan. This is again on the weight loss drugs, another series of clinical trials for those people with diabetes. The name of the drug, you heard it before, CagriSema. You lose 15.7% of your body weight. The expectation was higher than that at 20%. And when you run the trial over 68 weeks, about 2/3 of the trial group were taking the highest dose. But it's bad news for those new weight loss drugs, the next-gen weight loss drugs. Now, it's interesting we've pivoted into the red since I spoke to you an hour ago on Airbnb. You have an upgrade from Jefferies. They talk about buying durable growth, 38% upside, $185 is the target. But with the discussion that you're having about the shift to neutral from HSBC, the discussion around recession, how long before that percolates into Airbnb? This is a white-collar recession, morphing down to the blue-collar recession. Jonathan, good morning.
Manus Cranny, always talking about a vacation. One of the best. Manus, my friend, thank you, sir. Appreciate it. Let's look ahead to fresh inflation data with US CPI on Wednesday and PPI on Thursday. Michael McKee, our economics and policy correspondent, joins us now for more. Mike, what are you expecting this week?
Well, why wait till Wednesday? We start today with the New York Fed's survey of consumer expectations, which contains expectations about where they think people think inflation is going. It has been relatively steady compared with the University of Michigan numbers. And so let's see if it stays that way. Rest of the week, we get JOLTS tomorrow, but JOLTS is not that big a deal anymore. It's expected to go up, but these are January numbers and wouldn't reflect anything that's been going on in Washington, so it may not be very relevant anymore. U.S. CPI, as you mentioned, on Wednesday, and PPI on Thursday. Then we could go back into that. What do we think PCE is going to be? Jobless claims should start reflecting an increase, a bigger increase in the ongoing claims for federal workers as that continues. And then we get on Friday, the Michigan sentiment figures. We'll see if people still think inflation is going higher and whether that's a problem for the Fed. But the Fed's going to be sitting back this week and watching. No Fed speak because we're in the blackout period.
And the chairman got the final word in many ways. Mike, appreciate it. Thank you, sir. Really tackling the policy issues head on last week in a way that he's avoided in the news conferences.
He laid out just how much they seek to transform and why that makes it so difficult. And he uses the catchphrase that surveillance uses, which is parsing out the signal from the noise. You know, he's trying to figure out what is real, which highlights the backward-looking effect of some of this data, the fact that a lot of people are going to be discounting CPI as Biden data.
Or Trump data, depending on how good or bad it is.
Trump data.
Right? It just depends how bad or good it is.
Exactly. And then we could decide. At a certain point,
now.
When's the statute of limitations up on that?
I've got no idea. They can do it for as long as they want, right? You know?
Sure.
It's their opinion.
Go
They're entitled to it. Let's turn to Washington and President Donald Trump refusing to rule out a recession for the United States and the economy, saying the U.S. should expect a period of transition as he rolls out his wide-ranging tariff agenda. Joining us now for more is Neil Dutta of Renmark. Neil, good morning to you, sir. I want to take a step back with you because I think you're talking about something much bigger than just tariffs. In fact, you've pointed that out several times in your research. You think maybe something bigger is happening here. I want to give you the opportunity just to share your thoughts.
Well, I think what's important is while there's a lot of sort of enthusiasm, I guess, to kind of lay everything that we're seeing at the feet of the Trump administration, I think the truth is that things were slowing before they walked through the door. I mean, even February is, hard to say that this is all a function of policy uncertainty and tariffs. And in the 3 months ending in February, total hours worked have actually contracted. That's pretty rare on a 3-month basis. So it tells you that, the economy was already slowing and there was a lot of weakness in trade. You can make the argument that, trade-related policy uncertainty is what's, potentially dimming the outlook. But the consensus was offsides on the data as it has been coming in for the last several months. And some of that data reflects things that have already happened, right? So, I think that's important. Incomes are slowing, the housing market's frozen up. Increasingly, it looks like the labor markets have been sluggish, and government spending, particularly for state and local governments, has been getting sliced and diced long before DOGE came on the scene. So, I think these are sort of very interesting things to consider. And one of the things that we're learning is, well, number one, the Powell put, the strike price on that is lower than we thought. And we learned more about that last week. But also, I think the strike price on the Trump put is lower than we thought. So
Neil,
when you have both ends of D.C. Embracing the labor market, even though it's getting worse, that's not necessarily a good place to be for risk appetite.
So, Neil, let's use that as a starting point. You've been pretty consistent about this for a number of months, that you think that the economy is a lot weaker than a lot of people had been pricing in, and that you thought that the Fed would have to respond. It raises a question of the fragility to headline risk, the fragility to the uncertainty that we hear already coming into some of the CEO commentary coming out after earnings. Do you think that it is even more susceptible to some of what is happening on the policy front?
Well, I mean, look, it depends. So, for example, last week, we've been seeing the markets kind of get dinged every time there's some kind of a trade announcement, right? But you're not really seeing that relief when the trade announcement is undone, right? So, for example, with Mexico-Canada tariffs, I mean, we put 25% tariffs on everything coming in from Canada and Mexico, and then the next day, we exclude everything that's under the sort of umbrella of the USMCA. So we're tariffing everything and exempting everything all at the same time. And you didn't really see much relief in the markets from that. So to me, that suggests, number one, maybe the uncertainty is hurting to some extent, but also there's something beyond just trade that's driving markets. And I think it's sort of a deterioration in the data and what that means for the outlook going forward, because it's not like the Fed's about to step in. So the fact that the Fed's not willing to step in, even though the economy already has slowed, reinforces that downside.
Hold on a second, though, Neil. But a lot of companies have come out. Best Buy, Target talked about how they are probably going to pass along price increases to consumers and expect to sell less as a result of some of these tariffs. We're already hearing about some companies shuttering certain operations to try to deal with some of the ebbs and flows of tariffs that come on and off. Are you saying that it has had no effect and that essentially the vast majority of everything is just the existing economy that was slowing, and that essentially it is Biden data and not Trump data?
Well, I think it's dramatically oversold. I mean, it's one of these things where things are going well, it's, my growth strategy. And now when things are not going well, it's the uncertainty that came out about in the last week and a half. I mean, it's sort of, I think that's kind of amusing to me. But I would just say that you may be, I thought the comments from Kevin Hassett were interesting, where he's basically talking about reciprocity. And, remember, one of the ways they've long said that they plan to use tariffs is an escalate to de-escalate situation, right? So do you get the heat dialed up to dial the heat back down, and you get other countries to reduce their tariffs? I mean, how is the stock market going to respond to that? So, I think what companies largely deal with is what's right in front of them. And what they're seeing, I think, is that demand has been slowing, and that's probably prompting additional caution in their outlook. I don't think that they're making wholesale. Maybe some of them are, but I don't really think that's the big story here. To me, the big story is government spending was already getting worse, particularly state and locals. Housing has been locked up. Labor markets have been locked up. What Trump's doing isn't helping. But those are much bigger considerations, I think, than policy uncertainty.
Neil, let's talk about the potential upside, though.
That high, right? I guess the question I would have for you is, when does it matter, Lisa, when policy uncertainty is high, right? Is it when there's a financial market shock to go along that? Because if you look at credit spreads, they're relatively tame at the moment, right? So that to me. Yeah, they're rising from very, very low levels. You need a magnifying glass to see the increase.
Neil,
but
can we talk about the market upside, though, you mentioned? Because Scott Bessent, you mentioned the Trump put or the Fed put. Scott Bessent last week said there's no put. He said the Trump call on the upside is if we have good policies and the markets will go up. When can we see that? And what kind of strike price are you looking at?
Well, I don't know. It's like anything else. You have to kind of peel back the onion and kind of think about what they're really trying to say here. And what that means is, they may be, look, they're playing a game of chicken, both ends of DC with each other. It's exhausting, but it is what it is, right? And I think at some level, what they're trying to do is kind of, maybe get the Fed you can see a scenario where the Fed's cutting interest rates in the back half of the year, probably somewhat aggressively, maybe 100 basis points in the back half. At the same time, we're past the kind of uncertainty regarding trade, and then you get the Fed cuts, and then you get the call option, which is the tax law getting extended. And, sort of the market's focusing more on lower taxes and deregulation again.
Neil, just quickly, what's the threshold for those cuts from the Federal Reserve? What do they want to see? What do they need to see?
The data's going to get worse, and inflation's not going to be as strong as they think. I mean, that's really what it is. I mean, you talk about inflation expectations. Mike McKee was talking about how there's going to be inflation expectations coming out this week, today and at the end of the week with the UMich data. Why do we care about inflation expectations? Because people take those expectations and then try to bid up their wages. Good luck. Good luck with that. See how it works out. I don't think that people are going to be able to actually bid their employers up for higher wages no matter what their inflation expectations are, because no one's quitting their jobs. So firms have no incentive to pay people up. So I think people are in, to the extent they have those expectations, I think companies are going to be in for a rude awakening if they try to meet those expectations. I think people are going to be much more resistant to higher prices than companies believe. It doesn't, again, so tariffs, are they inflationary? Yeah, maybe, but I think the bigger issue is the increased costs. So we don't know exactly how much of the cost increase is going to be passed through to consumers.
PSA on my side, Neil. I just want to say to everyone out there, push, keep asking, know your worth. Neil owns his own company. He's talking his book. Neil Dutta, appreciate your time. Neil Dutta of Renmac there. One of the best. Thank you, sir. Don't ask.
Okay,
make sure you ask if you're at Renmac. Go to Neil's desk, go to his office this morning.
Especially. Okay, wait, who does that? Does anyone look at the University of Michigan inflation expectations and say, I need a raise? They take that data and they take it to their employers. I love that.
No, but what we did hear from Veronica Clark earlier is it feels like it's the employer that has the leverage right now in this labor market.
Neil has leverage.
Yeah. Ashok Bhatia of Neuberger Berman joins us now. He writes, we anticipate a favourable fundamental backdrop in which resilient US economic growth coincides with manageable inflation and declining interest rates. Ashok joins us now for more. Ashok, welcome to the programme. That's a more constructive view on things. Just walk us through where that comes from.
Yeah, look, I think we agree with a lot of what Neil was just talking about. I mean, the U.S. economy enters this period. There's definitely softening. We're softening from a 3% GDP rate to something around 2%. And that was sort of the natural underlying outlook for the economy this year, and inflation coming down. And, when we think about our baseline, we've been expecting, the average U.S. tariff rate's about 3%. And, we think the big challenge now, obviously, is the U.S. tariff rate, based on what's been announced, likely to settle somewhere between 6% to 16%. And 6% is an outcome we think the economy can manage. 16%, which would reflect full implementation of a lot of the different things that have been discussed, and retaliation, that's a harder outcome for the U.S. economy to manage. So, this year, obviously, we've seen this decline in bond yields. We've been reducing a little bit of our duration exposure in U.S. interest rates, and at the margin, seeing a little bit more opportunity today in the European bond markets, given a lot of the moves we've seen there this year.
Let's kind of delve into that. Are you basically saying you're going to move against the trend right now where people are seeing yields in Europe go up and yields in the U.S. go down? Are you betting the other side of that, and that you think that yields are going to be stickier in the U.S. and that yields are going to come in from where they are currently in Europe?
Yeah, the way we are positioned is to expect after, last week saw a 40 basis point rise in German 30-year yields. You look over the last 3 years, the average change in a week of German yields has been about 2.5 to 3 basis points. So significant rise last week. And the environment we see is that capital, at the margin will be kind of re-domiciled. And we think European capital will increasingly stay in Europe at the margin, and that European yields will find a bit of a bottom here. Or top. What we're worried a little bit more on the U.S. side is certainly this growth slowdown the Fed can ease, but we're a little bit more cautious on long-term U.S. yields at these levels. And the idea here is there's a couple of forces. You've got real yields and lower growth. That would tell you yields go down, but government spending, deficit spending, and term premium creates a little bit more upside pressure potentially in U.S. long-term yields. So we like the front ends of U.S. markets and the long ends of some of the high-quality European markets.
This is really important, Ashok, because a lot of people have been talking about how maybe the U.S. policy of potentially slower growth in the U.S. was by design to jawbone 10-year yields lower to offset some of the interest expenses that have been going up pretty dramatically. We said years ago, don't fight the Fed. Why not say now, don't fight the Trump? Don't fight the sort of Trump put on Treasury yields, frankly.
Well, I think there's a little bit of, like in our view, a little bit of difference there, right? The Fed has got ultimate power to set where it wants short-term rates. And a lot of the reason you have, for interest rates, a Fed put is because the Fed's got that full power. For the long end, what we're a little bit more concerned about is, yes, if the administration can thread this needle of spending cuts, maintain growth levels, and a credible plan that we're maybe at peak deficits and debt levels, doesn't have to drop overnight. But that sort of thing, definitely, that was the start of the year. It supports long-term 10-year yields. I think the challenge we see now is that if we do get a bit more of this slowdown on some of these stronger tariff policies, all these spending cuts could end up just being thrown out in the wash of, as U.S. growth slows, tax revenues slow, and automatic stabilizers increase, and there's going to be this upward pressure in deficits just naturally from that. And then that is sort of the story for why term premium can re-expand, or the risk of some of these longer maturities given the debt outlook. So there's a lot in play here, but I think it all comes down to, this policy mix is a lot of things that have to all go right. And, the administration, I think, will be trying to get back to that balance, but that's the risk, obviously, that's out there.
Ashok, can you translate that in much more simple terms? Are you suggesting that in an economic downturn, we might face a situation where bond yields rise and they don't fall at the long end?
I think what we're more worried about is that we see an economic downturn and long-term yields don't fall as much as they should in a downturn and a Fed easing policy. And that's a risk that we see rising right now.
Wow. And what kind of levels do you think would be the kind of floor where we'd settle at and that you would get concerned because they weren't falling enough?
I think, what you'd ideally want to see is if the Fed is, and again, these are all depending on how much of a slowdown. Our base case is the Fed will deliver 2, maybe 3 types of eases this year. I think you watch whether or not the 10-year note can get a lot below 4%, or if some of these counter forces prevent the 10-year yield from going a lot below 4%, which is what you would probably normally expect in that kind of Fed easing environment.
If we didn't get the comfort from the risk-free asset, what would it mean for the rest of fixed income, the more risky pockets of financial markets?
Well, I think as Neil was talking about, and I think he mentioned, you have to use a magnifying glass on credit spreads, and that's completely accurate. This has been a very modest widening of spreads. For people that maybe don't follow bonds every day, high yield spreads are about 14 basis points wider on the year. That's that's not a whole lot. European spreads have actually been doing quite well this year on, I think, some of these diverging growth outlooks. But I think that would be an environment where you see, a little bit more upward pressure in spreads, just given the slowdown and the starting point. And a little bit more divergence, obviously, within some of the sectors that are being pressured a little bit more by government spending cuts.
Still sub 300 on high yield spreads. We were very close to 400 last summer, just to give you an idea of where the last 12 months have taken us. Ashok, good to catch up with you, sir. Appreciate it. Ashok Bhatia there of Neuberger Berman. Thank you. Really interesting thoughts there on how treasuries would respond in a potential, and I stress potential, economic downturn.
It's not necessarily that yields would go up. It's they wouldn't go down nearly as much as people normally would expect in a downturn, which doesn't provide the sort of boost to borrowing that otherwise you would get in some sort of recession.
Yields are lower this morning, though. We're down by 6 to 7 basis points through the curve. On a 10-year, we're down by 6 to 7. We're down to about 4.24. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg Brief. President Donald Trump says he's negotiating with 4 possible buyers for TikTok's US business and that a deal could come soon. Trump didn't specify who the contenders were. Elsewhere, a student activist at Columbia University who led anti-Israel protests last spring has been detained by immigration authorities. The student's attorney says immigration officials are trying to revoke his green card. And elsewhere, finally, Morgan Stanley's Mike Wilson says stocks are at risk of slumping another 5% on concerns about tariffs and lower fiscal spending. Wilson expects the S&P to hit a low of about 5,500 in the first half before recovering to 6,500 by year end. The title of his note today, no pain, no gain.
And it's this sort of nuance that he's not necessarily bearish. Just to be very clear, he is just seeing that potentially there is more downside before there is upside. I'm just saying, because he's kind of pushed back on that.
More downside this morning. Equities near session lows going into the opening bell. Up next on the program, we'll set you up for your day and your week ahead from New York City. You're watching Bloomberg TV. The opening bell about 36 minutes away. Equities near session lows. We're down across the board once again this morning. No real news this morning. I have to say that. Apart from some comments from the president over the weekend, not exactly batting away recession fears, but this is follow through from the negativity of last week. We're down another 1.6 on the Nasdaq 100. As we count you down to the opening bell, some things to watch going through the week. 2 p.m. Eastern Time, President Donald Trump meeting with tech CEOs at the White House. 3 p.m. signs another round of executive orders. On Wednesday, CPI plus President Trump's tariffs, a deadline on steel, on aluminum, 25% in the mix. Thursday, PPI, another round of jobless claims. And then on Friday, the U.S. government shutdown deadline. All of that still to come.
I love it. You're trying to jinx us. No real news yet. It's like not even 9 a.m. Eastern time. Just wait. Exactly.
It's quite a move.
It is quite a move. And I think part of the reason why is because of all of the changes to the forecasts from Wall Street houses, where suddenly they do see a hit to growth and they do see potentially just a shift up in inflation.
Mike Wilson is sounding like the president and Scott Bessent. The path is likely to volatile. Yes.
I think he's just listening to what they've got to say. And what they're saying is we're determined to rebalance the economy. And they're willing to ignore the short-term disruption, the period of transition.
So the market hears that and says, he's not going to come to our rescue. That Trump put is in a coma right now. And so anyone who is betting that that would be the ultimate pressure valve, it's not happening.
Speaks to the move we're seeing right now. We're down by 1.3% on the S&P. Coming up tomorrow, we'll catch up with Brian Levitt of Invesco, Lisa Shallett of Morgan Stanley, Holly O'Neill of Bank of America, and Lindsay Rosener of Goldman Sachs. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special BNP Paribas Open update for Bloomberg TV and Radio from Tennis Channel. Iga Swiatek sailed into the fourth round with a routine win over Diana Yastremska. The defending champion dropped just 2 games in the victory that improves her record to 20-0 in the desert. Only legend Martina Navratilova has a better winning percentage.